A good evening and a warm welcome to all my dear members for today's webinar on class-by-class analysis of tax audit report. First, I would like to wish all our members a happy 150th Gandhi Jayanti. At the outset, I would like to thank and also welcome our today's faculty, E. Chaitanya Garu, in spite of his busy schedule, have accepted our invitation to participate for today's webinar. This majorly, we are going to conduct 2 webinars in the current month, and both the programs will be relating to income tax. The first webinar that we are going to see now will be on class-by-class analysis, and tomorrow also we will be having a webinar on various sections of income tax, maybe the latest changes 206C1H relating to TCS and 194N section which was introduced last year, and there were few changes in section 32 depreciation and major 48.3 there was a change. 43B what we have to do when it comes to March month interest, whether we have to dissolve or not, because we have to finalize our audit reports before 31st October, and IT returns filing date is different. So before before the closure of the IT returns date, we are going to file the returns. So what we have to take a stand on all those aspects. Today and tomorrow we'll be going to have a detailed discussion on that. Dear members, the last date for submission of MEF form would be the 12th October 2020. As there are a lot of changes in the MEF form this time, instead of filing the form on the last date, it is better to apply as early as possible, so that if there are any discrepancies, we can discuss and get it resolved at the earliest. So that at the end there may not be any hiccups for members. I would like to inform this change, and I would also like to bring to your notice that the November month CA exams will be conducted as scheduled, and there will be no further postponement, and all the safety measures will be taken from the institute side. So I request the members to inform your article students about this fact and make them ready for the exams. Dear members, in many occasions I have noticed that the accountant and sales tax auditors are of the opinion that the due date for audit cases was 30th November. Since the due date of filing the audit report for the assessment year 2021 was 31st October, and we are supposed to enclose the financials along with the audit report. The November due date for filing of income tax return is of no use for us. So in this regard, I would like to request you to educate the accountants or SCs or sales tax auditors and clearly state that the last date for tax audit cases would be the 31st October, so that necessary action would be taken up by them, and without any further delay or without much last minute rush, we can close our tax audits. Small introduction. Now over to you, Arun.
Thank you, sir. So now I request CA Lakshmi Prasanna Madam to introduce our speaker.
Good evening. CA Chaitanya Garu, he is a postgraduate in commerce from Sri Venkateswara University, Tirupati. He is a qualified chartered accountant in January 2005. He qualified the Information System Audit course of ICAI with 3rd rank. He completed the certification course of ICAI on International Taxation. He completed bachelor's degree in law in 2020. He is in practice since 2005. He has varied experience in statutory audits, internal audits, and tax audits. Clientele include various listed and unlisted companies, banks, insurance companies, trusts, firms, and other entities. He has been representing before various income tax authorities and has also been actively involved in the preparation and presentation of appeals before CIT appeals and ITAT Hyderabad. He has written articles on direct taxation for Chartered Accountant Study Circle, CASC Chennai, and International Fiscal Association IFA Chennai chapter. He specializes in direct taxes with keen interest in international taxation, and he hails from a family of chartered accountants. Thank you. With this, I welcome today's faculty for the seminar.
Thank you, madam. Now I request our faculty, CAE Chaitanya Garu, to take over the session.
Thank you, sir. Sir, I will be sharing my screen, and kindly let me know in case my screen is not visible to you.
Definitely, sir. Definitely.
Hope my screen is now visible to all of you.
Yes, sir.
Respected Chairman, sir, Vamsi sir, members of the Managing Committee of Nellore branch of SARC, participants, good evening to all of you. On a holiday, most of you joining on this webinar to know more about tax audit is something that is very enriching. In fact, last year also, Vamsi sir was saying that last year also I was doing the presentation on the tax audit. So this year also I've come again to have the review of the clause by clause analysis of the items appearing in the Form 3CD. As you all know, tax audit is a very annual affair. We do it on an annual basis, and every time we have to hone our skills, we have to make changes to whatever we know so that we don't make a mistake in conducting the tax audit. As you all know, there is now a quality review board, QRB, which has been set up only to review tax audit reports. It doesn't undertake reviewing the normal audit reports. Only tax audit reports are being assessed by a separate wing of the ICA called as the QRB, and the QRB is now taking up the cases relating to errors in tax audit report, and in fact it is also referring to the disciplinary committee of the institute. So tax audit has now become altogether more serious. We need to conduct it in a proper way and then discharge our attest function in a proper manner to ensure that there are no errors that are coming out of the tax audit report. And it is very common knowledge that all our assessees would come only in the 11th hour, and we have very little timelines to conduct the audit, and we normally do it in a very hurried manner. So the challenges that are there on tax audit have not changed, but the regulators have time and again kept on increasing the responsibility on the auditors to a very large and greater extent. In this scenario, for us to comply with the accounting standards, the ICDS, the auditing standards of the institute, and then complete the tax audit report, which is a very, it is a document which contains numerous pages and number of clauses. It is a very Herculean task to do all these things at one point. So it is up to us to rise up to the occasion, not wait for the client to come up with a particular specific issue. We have to be well prepared to handle him upfront itself, because the timeline available to complete the audit is very short. In this scenario, the first point that I would want to go on the issue of introduction of the tax audit report. On the topic of introduction alone, we'll be spending around a couple of minutes, so that we need to know what is the original basis of this tax audit. Otherwise, we'll not be able to appreciate it in the right sense. So that being the scenario, the first issue that would come up in the case of introduction is that should an auditor review only the accounts of the assessee, or should he in fact restrict himself to the business accounts of the assessee, or should he go beyond the business accounts and should review the personal transactions of the assessee? Once upon a time, when the tax audit was newly introduced, we have the decision of the Guy Construction in Bombay High Court, which has held that the tax auditor must restrict himself only to the business accounts of the assessee. There is no need for him to go beyond the business accounts of the assessee. That means he should have restricted himself only to the books of accounts relating to the business. He need not worry about the other personal transactions of the assessee. To put it in another way, he should restrict himself only to the head, profits and gains from business or profession, and he need not travel to the other heads of income, was the original intention of the introduction of the tax audit. Tax audit, as you all know, was introduced to ensure that there is lesser complaints burden on the, there is a greater complaints burden on the assessee, and the officer is relieved of the issues that are there in the tax audit report, because to that extent he need not review, and it has already been completed by a chartered accountant. Now, in this scenario, in this framework, now in the present scenario where we have numerous pages of tax audit with 44 clauses, do we think we should still restrict to the business accounts of the assessee, or do you think we should travel beyond the scope of the business books of accounts? In my view, the answer is a clear no. We cannot restrict ourselves to the business books of accounts, because the while I would definitely agree with the fact that the tax audit report, majority of the clauses would lay stress only on the entries relating to the business of the assessee or the profession of the assessee. There are few clauses which talk about the personal transactions of the assessee. Take the case of clause relating to 56.210 or 56.2.9. These are all clauses which fall within the ambit of the personal transactions of the assessee. They would fall within the scope of income from the head, income from other sources. Now, the tax audit report does not want the auditor to restrict himself only to the head profits and gains from business or profession. It wants the auditor to move beyond. It wants the auditor to move beyond the head of PGBP, go to income from other sources and deal with the transactions that are there. And in case if there anything that is reportable, they have to be reported in the tax audit report. So gone are the days where a tax auditor can file only the business P&L account, business balance sheet of the assessee and say it is true and fair. That scenario is now, in my personal view, no longer good, because now we need to file, we need to certify not just the business balance sheet of the assessee but also the personal balance sheet of the assessee to a certain extent, and we need to keep reporting in that manner. Anyway, when an assessee is filing an income tax return, he cannot restrict himself only to the business balance sheet and P&L. He has to report his entire thing. In that scenario, the auditor is also having his own obligation in reporting those matters. Now, as I've already discussed on this issue, I'll be quickly moving on to the other issue of why a tax audit report is relevant. As you all know, in fact, in the opening speech, Chairman sir was saying that the tax audit due date is not 30th of November, but it is 31st of October. I would definitely agree with that. And I would also like to remind you of the changes that have been brought in by the Finance Act 2020. Finance Act 2020 has divided the specified date under two different sections. You have a specified date under 44AB. You also have a specified date under section 139. The date under 139 talks about the date of filing of the return of income. The date under 139 talks about the date of filing of the return of income. And the date under 44AB talks about the date on which the tax audit report should be filed with the income tax department. 44AB talks about the date on which the audit report should be filed with the department. Now, in the online portal, the tax audit report should be filed before 31st of October. The tax audit report should be filed before 31st of October. If you don't file, then you are inviting the penal consequences, which is this 1,50,000 rupees or 0.5% of the turnover fine, whichever is lower, can be levied as a penalty subject to you not exhibiting the reasonable cause. So if the tax audit report has to be filed before 31st of October, if it is not filed, as I said earlier, you will be inviting the penal consequences. But be that as it may, 31st October is the last date for filing of the tax audit report. I'm repeating again, it is not the date of filing of the return of income. The return of income due date is still 30th of November, while the tax audit report date alone is 31st of October. The reason for bifurcating the tax audit report date and the return date is that the income tax department wants the data that is being put in the tax audit report to flow automatically to the return of income of the assessee. So for example, if a person is filing his audit report on 1st of October or say on 2nd of October, today if he's filing his audit report and if he's opening his income tax return on 2nd of November to file his income tax return, by then the data from the tax audit report is intended to be carried to the return of income automatically. This is the purpose behind splitting the tax audit report date and the return of income date. But what the Income Tax Act, in my personal view, failed to address is that you look at section 43B. It says, the first proviso says, where any of the taxes due which have not been paid, if they are paid on or before the due date of the filing of the return mentioned in section 139(1), then it shall be treated that they have been paid and it will be treated as an allowable expenditure. So you have a tax audit report which is getting completed on 31st of October, and you also have a return of filing due date which is 30th of November. 43B allows you to travel till 30th of November, but your audit report should capture all the disallowances still on 43B by 31st of October. So to that extent, there is a lacuna, but be that as it may, the date is now divided. You have 31st October date, which is the last date for filing of the tax audit report, and you have 30th November date where you can go ahead and file your return of income. But in all certainty, if you are filing beyond 30th of November, you will be attracting interest and other penal consequences. But be that as it may, 30th November is the last due date for filing of the return of income. The Act under 139(1) gives the due date as 31st of October. The due date is 31st of October, and the specified due date under 44AB is 1 month prior to that date. Since 31st October got extended to 30th of November, automatically the return due date, the tax audit due date also got extended by 1 month, which is 31st of October. Now, why not? This is not just one scenario that I'm trying to say. The most important aspect of the tax audit report and the return of income lies in section 143(1). 143(1) states that where there is a disallowance of expenditure indicated in the audit report, and if it is not taken into account in your return of income in the computation, then automatically you will be given a 143(1) by making an adjustment. So under 143(1) itself, 143(1) also is it is a mechanism in which some of the adjustments are permitted. See, there are different sections under the Income Tax Act where an officer can permit, where the Income Tax Act permits an officer to make an addition. 143(1) is one case, 143(3) your scrutiny assessment is another case, 147 read with 143(3) is another case, 263. I can name any good number of sections, but 143(1), the speciality under 143(1) is that the officer of the department or the portal will make an addition to your income, and there will be no levy of penalty to that extent. So if there are any changes that are there, to that extent 143(1) will make an adjustment and give you the intimation. One such change, one such adjustment permitted under 143(1) is the disallowance of expenditure indicated in the audit report but not taken into account in computing the total income. So if there is a disallowance of expenditure in the audit report, and if it is not getting captured in the return of income due to various disagreements between the auditor and the assessee, then to that extent the assessee's intimation will reflect that disallowance and it will get added to his income. So in other words, whatever is the disallowance indicated by the auditor has to be mandatorily be thrust upon the assessee. It has to be mandatorily be included by the assessee in his computation. Even if he doesn't include it in the intimation, they will make an adjustment and then give you. So please be very, very careful while reporting the item. You put it as a disallowance, it will automatically get adjusted in the 143(1). I know in between there is a process called as proposal for adjustment, where they'll give you a proposal. You will have an option of accepting or rejecting it, and even if you reject it, sometimes it appears in your 143(1). Be that as it may, I'm not discussing or going into the depths of the proposal for adjustment, but I would only like to tell you that 143(1) has an inbuilt mechanism where the disallowance indicated in the audit report will automatically flow to your return of income in your intimation. So to that extent, you will have to exercise utmost caution wherever there is a reporting under the audit report, especially relating to disallowance. So to that extent, the tax audit report becomes all the more significant. Now, when is a tax audit applicable? We have some changes coming up in the current year also. I will try and cover all those changes. There are 4 scenarios which have been brought out in 44AB. First is the scenario relating to business. If the turnover exceeds 1 crore, then you will have to get your books of accounts audited. If the turnover exceeds, if the turnover is not from a business, but if it is from a profession, then to that extent, if it exceeds 50 lakhs, then you will have to get your books of accounts audited. The word profession defined in 44AB has got no reference to any specific profession. So any profession will get covered under 44AB. And the word profession has been defined in the Income Tax Act to include a vocation also. So if a singer, the recently demised legendary singer S.P. Balasubramaniam sang the songs without any formal training. So if he's singing cinematic songs without any formal training, will it be called as a profession? Yes. Is it strictly a profession? No. Under which one will it come? It will come under the definition of vocation. Normally, profession would require specific skill set, specific knowledge, and putting up that knowledge and the skill set into practice. But a vocation is something that you earn out of your inherent ability. So profession includes vocation. So all professions which are treated as professions would come within the limit of 50 lakhs. If it is below 50 lakhs, then you need not go under 44AB. But if it is above 50 lakhs, then you will have to mandatorily go and get your books of accounts audited. The same is the case with chartered accountants. If your turnover exceeds the prescribed limit of 50 lakhs, you will have to get your books of accounts audited from another chartered accountant. So this is how 44AB is worded, and nothing is new here. Everything is what you already know. I would only like your attention to serial number 3 and serial number 4. Serial number 3 talks about 44ADA or 44AE. 44AE talks about transport business or carriage of goods in vehicles, and 44ADA talks about specified profession. There are only 13 specified professions. All other professions have been covered by the second clause itself. The third clause talks only about specified professions. In the case of specified professions, if your turnover is less than 50 lakhs and if you are willing to admit 50%, then you need not get your books of accounts audited. Same is the case with 44AE. If you are engaged in the business of goods transportation, if you are owning less than 10 vehicles, and if you are willing to offer the profits as mentioned in 44AE, then you need not get your books of accounts audited. 44ADA and 44AE are very, very simple. Within the limits prescribed in those sections, if you can be either under 44ADA or under 44AB. If you are not willing to go under 44ADA, you have to mandatorily go under 44AB. If you are not willing to go under 44AB, you will have to mandatorily go under 44ADA. So either you are within 44ADA or you are within 44AB. You cannot avoid both the sections. Now, that is not the scenario as far as 44AD is concerned. I am not going into the depths of this 44AD-AE and 44AD-A because I only spoke on these topics of presumptive taxation just 2 months ago. So there is a distinction between 44ADA and 44AE in one aspect and 44AD in another aspect. These three sections are not comparable. 44ADA and 44AE are in a different basket. 44AD alone is in a different basket. 44ADA, 44AE, as I already told you, you are either under 44ADA or you are under 44AB. You don't want 44AB, go under 44ADA. You don't want 44ADA, go under 44AB. This is simple as far as 44ADA or AE is concerned. But if you come to 44AD, that is not the case. You need not enter 44AD at all. For example, take the case of an SSE who is having a turnover of 80 lakhs. He can choose not to go under 44AD. The first year of business, he can choose not to go under 44AD. As long as he chooses not to go under 44AD, 44AB is also not applicable because his turnover is less than 1 crore. So he need not get his books of accounts audited. Had the case been that the turnover is 1.5 crore, then he can choose not to go under 44AD, even in that scenario also. But since his turnover exceeded 1.5 crore, he will have to go under 44AB. So to that extent, there is a distinction. But the moment he enters 44AD, 44AD now talks about a period called as a block period. Block period consists of 6 years. The moment you enter the 44AD, your block period starts. It is not necessary that the block period will start from the assessment year 17-18 onwards. After that date, the block period can start anytime you enter 44AD. The moment you enter 44AD, it could be in assessment year 17-18, 18-19, 19-20, which assessment year is irrelevant. The moment you enter 44AD, your block period starts. And it is a period for 6 years. As long as you stay within 44AD, there is no problem. But the moment you come out of 44AD, that 1 crore limit is not applicable to you. For you, you have to mandatorily get your books of accounts tax audited under 44AD. For example, I entered the block when my turnover was say 1.5 crore. I entered the block period of 6 years under 44AD. For 3 years, I admitted under 44AD. My turnover was 1.5 crore. I admitted only 8%. Suddenly, for the assessment year 2021, my turnover fell down to say 40 lakhs. My turnover fell down to say 40 lakhs. Now, if you are under 44 AD, that block period, you will have to admit 8%. I was not willing to admit 8%. I said I will come out of 44 AD. I will offer lower profit, say 5% I'm willing to offer. In that scenario, even though my turnover is only 40 lakhs, I'll have to necessarily get myself audited under 44 AD. So this turnover of 1 crore is applicable only to straight cases. The moment you enter the 44 AD block, this 1 crore limit is not applicable to you. Only 44 AD limits will be applicable the moment you enter 44 AD. If you are not at all entering 44 AD, then no problem. For you, only 1 crore limit will become applicable. So to that extent, there is a distinction between 1 crore limit and 2 crore limit. The moment you enter 44 AD, you will have to remain in 44 AD at the rate of 8%. You will have to admit your profits for 6 years period. After that, the block gets over. You can come out and then decide again. But the moment you enter 44 AD and within 6 years, if you quit, then irrespective of the turnover limit, you have to get your books of accounts audited. This is the first precaution. Now, having covered that, we'll go to the business head once again. As I said earlier, as long as your turnover, sales turnover or gross receipts is less than 1 crore, then you need not get your books of accounts audited. In the current year, there is a change that has come up. What is that change? The change said that subject to the conditions, if your turnover is less than 5 crores, then you need not get your books of accounts audited. As long as the turnover is less than 5 crores, if the two conditions are satisfied, then you need not get your books of accounts audited. What are those two conditions? The two conditions are that all the receipts in cash should be less than 5% of the total receipts. All the payments in cash should be less than 5% of the total payments. If these two conditions are satisfied, then up to 5 crores, a person need not have his books of accounts audited. So if a person is dealing only in cash, only in checks, both the receipts and the payments, not just the receipts or not just the payments, both the receipts and the payments, if he is dealing 95% in cash or in check only, then the limit for him for tax audit is 5 crores and not 1 crore. Now, but look at the way in which this proviso is worded. I am again referring to the wordings of the proviso as it is. Provided that in the case of a person whose aggregate of all amounts received, including the amounts received for sales, turnover, gross receipts during the previous year, comma, in cash, aggregate of all amounts received, including the amounts received for sales turnover during the previous year in cash, does not exceed 5% of the said amount. How can, if you look at the wording here, it says the total amounts received in cash should not exceed 5% of that amount. I did not originally understand this language at all. What I'm trying to say, it says the total amounts received in cash should not exceed 5% of that cash amount. If that is the wording in which it is there, then obviously in every case 100 is always less than 5. So this wording has to be construed in such a manner that the cash payments or cash receipts should not be more than 5% of the total receipts. Unfortunately, that is not the way in this section is worded, but be that as it may, we'll have to construe it in that manner. Hope you have understood the controversy in this particular proviso. Having said that, we are now able to complete the entire 44 AB limits that have been mentioned here. Now, we'll move on to the words that are there. What are the words? They said sales, turnover or gross receipts should not exceed, sales, turnover or gross receipts should not exceed 1 crore or 5 crores. So what is sales? What is turnover? What is gross receipts? Sales. Sales is a very, very common word that we are using. What is sales? Sales refers to the aggregate of the sale consideration received for the sale of the goods or for the sale of the services. The word turnover is defined under number of statutes. Earlier we had the CST Act, now we have the GST Act, we also have the Companies Act 2013. In different legislations, the word turnover is defined. What does turnover mean? The old CST Act said the aggregate of the sale prices for the sale of the goods is called as turnover, was the definition under the CST Act. Now we have the GST Act, which says the aggregate of the consideration received for the sale of the goods or supply of services or including exempt turnover has been mentioned under the GST Act. Gross receipts is a word which is not defined in any of the legislation. So to this extent, you can understand that there is a word called as sales, there is a word called as turnover, and there is a word called as gross receipts. And the legislation section 44AB states that sales, turnover or gross receipts, as the case may be, should not exceed 1 crore. So sales, turnover or gross receipts, as the case may be, should not exceed 1 crore. So which one should I consider? Should I consider sales? Should I consider turnover, or should I consider gross receipts? What is turnover in that? If sales and turnover are the same, then why is there a necessity to mention sales and turnover? Turnover does not necessarily restrict itself only to sales. It can even include discounts given escalation in prices and other factors also. Turnover can have several other items included in it. For example, you are having reimbursement of expenditure. You are collecting expenditure, reimbursement of expenditure is happening on strict basis. For example, you have incurred expenditure for the client amounting to 5,000. You have given the bills exactly to that 5,000, you have collected 5,000. It is called as pure reimbursement expenditure. One-to-one matching is there. That means to the extent of expenditure you have collected, nothing more you have collected, nothing less you have collected. There is one-to-one matching of that expenditure. That is called as pure reimbursement expenditure. It will not form part of your turnover. But if you were to collect 10,000 rupees or one lump sum figure, and you don't disclose the breakup of that to your client, you will say as a part of reimbursement, you will have to give me 10,000 rupees. Like that, you have collected a lump sum figure. Then out of that, you spend only 7,000, 8,000 or 9,000. You don't spend the entire 10,000 and give him the bills. In that scenario, this reimbursement of expenditure will form part of your turnover. Same is the case with taxes. Taxes, if you maintain a separate account, apart from your sales price, you put it in a separate ledger. GST normally mandatorily requires you to collect all the GST in a separate account. So if you put it in a separate account, from there you collect the GST and then you remit the GST. That way, if you are dealing with it, then it will not form part of your turnover. But if you were to collect it in lump sum without disclosing item-wise breakup, which is not normally permissible in GST, in that scenario, it will form part of your turnover. So if there are any other taxes apart from GST, which are not disclosed separately in the invoice and accounted separately in the books, it is forming part of your sale price, then it will be included in the definition of your turnover. Similarly, if you are collecting packing charges, forwarding charges, transport charges, all that if you are collecting from your customer, and if it is not shown as a part, if it is not shown separately in the invoice, if it is collected as a single price in the sale price itself, then all that will form part of your turnover. So your sales could be a different figure, your turnover could be a different figure, your gross receipts could be an altogether different figure. Gross receipts would include everything on account of business. For example, you have subsidy received from government, it will be treated as gross receipts. You will have other expenditures coming up, it will all be treated as gross receipts. In that scenario, there is every possibility that your gross receipts could be a different figure, sales could be a different figure, and turnover could be a different figure. Cash discount. If your assessee were to give cash discount, will it form part of your turnover? The answer is no. Cash discount is more of a financing obligation, so it should form part of your expenditure. You cannot reduce it from your turnover or your sales figure. Whereas trade discount and volume discount, volume discount are majorly concerned with the sales. The moment you do some sales, you will be given a trade discount. You cross a particular threshold of quantity, you will be given a volume discount. In those scenarios, you will have to reduce it from the turnover figure. So there could be every possibility that your sale could be 100, turnover could be 80, and gross receipts could be 110. In that scenario, which one should I choose to decide whether tax audit is applicable to me or not? This section only uses the words as the case may be. What is the as the case may be? To know which word to pick, whether to choose sales, whether to choose turnover, or whether to choose gross receipts, which word to pick, you will have to refer to section 145. 145 states that in order to calculate the income under the head profits and gains from business or profession, you will have to go by the method of accounting followed by the assessee. So if the assessee is following mercantile system of accounting, accordingly you will have to pick sales or turnover or gross receipts. Turnover would be a more appropriate figure where an assessee is following mercantile system of accounting. If an assessee is following cash system of accounting, then gross receipts would be a more appropriate figure. So depending upon the case, depending upon the assessee, which word to pick will have to be decided in accordance with section 145 of the Income Tax Act. Now, as I told earlier, each word has got a different meaning. The calculation under each word will have a different result. So to that extent, please be very, very careful. In the case of speculative transactions, all the sales is not your turnover, all the purchases is not your turnover. The absolute values of the differences, it could be a positive difference, it could be a negative difference. Ignoring the sign, the absolute value of the differences will be treated as your turnover. After arriving at that turnover, then you will have to see whether your tax audit is applicable to you or not. In the case of F&O transactions, apart from this absolute value of differences, on the sales of options that you have made, to the extent you have collected premium, the premium received on the sale of options will also have to be added to this absolute value of the differences. And to that extent, you will have to decide whether the tax audit is applicable or not. So whether to know tax audit is applicable to you or not, you will have to decide which word is applicable to you and how to calculate that word, and then decide tax audit is applicable or not. In a majority of cases, there will not be an instance where you will be required to calculate tax audit limit, because normally it will be either much lower or much higher. But in case there are any borderline cases, then probably you can use this section to understand whether tax audit is applicable to you or not. Now, before I go to the clause by clause analysis, one important mention is the essential documentation which is required for a tax auditor: the appointment letter, management representation letter, significant accounting policies, working papers, very, very important working papers, key decisions taken, and their support or back. If you are relying on any case law on which you have excluded a particular disclosure, then you will have to keep all those decisions ready, so that tomorrow when the issue comes up, you will not be at loss of case laws or supportings to justify your case. So to that extent, you will have to keep all your working papers ready. Guidance note of the institute very clearly states that you should take a copy of Form 3CD signed by the client. Form 3CD is an attachment to Form 3CB. Form 3CB is your audit report. Form 3CD is the statement of particulars. There are several information in that Form 3CD. They cannot be compiled by the auditor alone. They have to be compiled by the assessee, and the auditor will have to perform a test check. So in order to perform a test check on the items given, you will have to take the Form 3CD alone. After filling it up, you will have to obtain the signature of the assessee on that form. This goes to show that the Form 3CD has been filled up by the assessee, and upon signing, it will be treated as verified by the auditor. So to that extent, please be very, very careful. I know most of you would upload your Form 3CD and you will get your Form 3CD downloaded from the income tax website. No problem. Download Form 3CD alone, take a printout, get it signed by the assessee, so that to that extent, you are on a very safer side. Now, what does Form 3CB state? Form 3CB is absolutely not new. It is the old Form 3CB only that I am talking about. As you know, Form 3CB is very peculiar to that to one extent. What is that extent? Form 3CB takes two certificates from you. Form 3CB takes two certificates from you. What are the two certificates? One, it says, I have verified the financials, including the P&L account, balance sheet of the assessee, and I certify that the financials are true and fair. I certify that the financials are true and fair. After certifying the financials as true and fair, you again go and certify that the information appearing in 3CD is true and correct. So, financials, you are certifying it as true and fair. 3CD documentation, 3CD correct accuracy of the information filed in 3CD, that alone you are certifying it as true and correct. So you will have two certifications in one 3CB. One is your true and fair view, another is your true and correct view. To the extent of true and fair view, if at all there are any discrepancies, if the assessee is not following any accounting standards, if the assessee is not able to disclose any particular item, if the assessee is not complying with the measurement, recognition, measurement and disclosure standards of any ICDS, then you will have to report that in 3A. Point number 3 in Form 3CB, A contains the list of observations, comments, discrepancies. You can give all the information relating to the financials in this 3A. But if you are having any specific issue in Form 3CD, then that information has to be given in point number 5B. It cannot be reported in 3A. It has to be reported only under clause 5 of the Form 3CD. So to that extent, there is a distinction. I hope you have understood that there is a true and fair view on the financials and a true and correct view of the items appearing in Form 3CD. If you go to Form 3CA, this true and fair view is not at all applicable because audit is already done by somebody else. You can only give true and correct view. This alone true and correct thing only is taken in Form 3CA. True and fair view is not required to be given in 3CA. 3CA form itself does not contain true and fair view because that is already been taken care. 3CA is applicable only in the case where audit is already performed. You are not conducting an audit under this act. Under some other act, the audit has already been performed. So to that extent, true and fair view need not be given because some other auditor has already given it under different statute. Tax audit alone you will have to perform, and true and correct view of the items appearing in 3CD alone, if you certify, it will be sufficient for the purpose of Form 3CA. As far as 3CB is concerned, I have already mentioned true and fair view and true and correct view. Both have to be given. Now, having discussed the introduction part of the tax audit, we will now quickly move on to see what are all the important clauses as far as Form 3CB is concerned. Again, there are two clauses which are not required for reporting. One is clause 30C relating to GAR, general anti-avoidance rules, and another is clause 44. Clause 44 is originally draconian because the total expenditure incurred by the assessee has to be broken up into 5 different categories. What are those? How many are paid to GST registered entities? How many are paid to non-GST registered entities? Among the GST registered entities, how many are paid to composition entities? How many are paid to real GST entities? And how many are paid to other GST entities? Like that, there is a huge reporting requirement that has to be given. Your entire expenditure, your total expenditure has to be broken up. It could include printing and stationery. It could include any expenditure, salaries, other expenditure. All your expenditure has to be broken up and it has to be reported. How many are paid to an entity which is exempt under the GST? How many are paid to an entity which is not registered under the GST? How many are paid to a composition entity? How many are paid to a normal GST entity? All that breakup has to be given. Fortunately, this requirement kept on getting skipped. At least for our good sake, it is kept in abeyance till 31st of March 2021. So to that extent, for the assessment year 2021, there is no need to report this breakup of the expenditure. Similarly, GAR, it is a very huge section. It is not possible for the auditor to verify GAR. GAR does not mean that it is applicable only to international transactions, big assessees. It can be applicable even to a small assessee. The only problem is that the tax liability that is intended to be avoided should exceed 3 crores. If the assessee prepares his accounts in such a way that he's evading a tax liability exceeding 3 crores, then GAR will come into picture even for a domestic assessee. So to that extent, please be very, very careful. Fortunately, both these requirements have been kept in abeyance till 31st March 2021. So to that extent, we have no problem as far as current 3CB, 3CD is concerned. Now, we'll quickly move on to clause 14. Due to paucity of time available, I'm not able to disclose all the clauses that are there, but to the extent of major clauses that are appearing in Form 3CD, I will try and discuss. The first clause being clause 14. Clause 14 is very much relevant in the current scenario, especially during this COVID times. What is it trying to say? It says the method of valuation of closing stock employed by the assessee has to be reported. If you are going by cost or net realizable value, you have to report that. If you are following some other method, you will also have to report that. It also says in the case of deviation from the method prescribed under 145A, then to the extent, is there an increase in the profit or is there a decrease in the profit, you will have to report. What is 145A saying? 145A simply states that your opening stock, purchases, sales and closing stock, all the items appearing in your trading account should be increased by the amount of taxes paid on them. Normally, what is the ICDS 2 saying? Original accounting standard 2 is different from ICDS 2. ICDS 2 has been incorporated in section 145A. So what is normal accounting standard? What is ICDS 2? Read with 145A. Normal accounting standard says, to the extent there are duties and taxes which are refundable from the government, do not include them in the cost of the inventory. This is what your normal accounting standard says. Normal accounting standard says, to the extent there are duties and taxes refundable from the department, do not include it as a cost of your inventory. So if you have any input credit that is coming up from purchase of raw materials or your trading goods, then to the extent of that input, it will not form part of your purchase cost. That is your normal accounting standard. What is 145A saying? It is saying, whatever are your duties and taxes, whether they are refundable from the department or not, you include it to your purchase cost. Whatever are the duties on the sales, you include it to your sales cost. Whatever is your closing stock, to that extent, if there are any duties included in purchase, to that extent, you include it on the closing stock also. Similarly, if you have any duties on opening stock, you include it in the opening stock also. So all your opening stock, purchase, closing stock, and your sales should be increased by the duties and the taxes. After increasing all this, if at all there is any profit coming, compare that profit with your normal profit. If that profit is higher, you'll have to pay profit on such higher profits. If that profit is lower, you'll have to admit income as per your normal profit. This is how 145A talks about. We will take up an example to understand better. This is called as inclusive method and exclusive method. In exclusive method, you do not include taxes, which is your normal accounting standard. In inclusive method, you normally compute as per 145A. So what is inclusive method? What is exclusive method? We'll take up as an example. Look at this. This is for 31st March 2019. That is the first year of business. 31st March 2019. There is no opening stock. To that extent, we are happy. Purchases 500, GST 100, inclusive 60. Now, sales 600, closing stock 100. This is the GST on that. Normally, what would you do? Sales is 600, closing stock is 100. So total is 700. 500 is the purchase. So 200 would be the net profit on which you will normally pay your tax. What will happen as per 145A if you include your taxes? 500 add GST, it will become 600. Similarly, on this also you add profits, you will get your inclusive method sales figure. Now, originally 700 now became 840. Original 500 became 600. So how much is the impact higher? The impact is now higher by 140. To that extent, I agree that the impact is higher by 140. Why? How come it has become 140? I mean 240. The impact is higher by 240 because in this side you have 840, whereas the purchase cost is only 600. So your impact is higher by 840. Now out of this 240, which is higher, this 20 rupees, which is the difference between the sales and the purchase, you have an input of 100, you have an output of 120. This 20 rupees, whatever is the difference there, that 20 you would have anyway paid. You would have anyway paid in the form of check cash because it is the difference between your output and your input. This 20 rupees you would have anyway paid as cash. So to that extent, it will be treated as your expenditure. But whatever is added on your closing stock, because of that also there is a difference. So if there is a difference of part, if your net profit wants to remain the same, then the GST payable is 40, which is extra. Out of this 40, 20 is coming as a reason of the sales minus purchase. The 120 minus 100, the first 20, which is forming part of this expenditure, is already paid in cash. So to that extent, we need not worry. But whatever is there on the closing stock, that is also coming as a part of GST payable. So whatever is the input that is added to your closing stock, this also has to be paid if you want to pay tax on your normal profit. When should this be paid? As per 43B, this should be paid before the due date of filing of the return. So what is the whole purpose of 145A? 145A indirectly states that whatever is your closing stock, this should be sold before the due date of the filing of the return. In that scenario only, whatever is the GST on that closing stock, that alone will get exempted. I mean, that alone will not form part of your, that one will form part of your expenditure, and to that extent, there is no increase in the profit. Due to this COVID, most of the assessees might not have been able to sell their closing stock, In that scenario, there is every possibility that there could be a disallowance on account of this 145A. So please be very, very careful while verifying your tax audit, while conducting your tax audit. So closing stock, the GST that is loaded on the closing stock, if the closing stock is not sold before the due date of filing of the return, then the entire GST that is remaining on such unpaid, unsold closing stock, it will form part of your disallowance. Please be very, very careful to that extent. Now we'll go to the second year. Second year, earlier year there was opening stock of 100, closing stock of 100. It became opening stock of 100. Now purchases, sales, as it is, they all continue. In this year, you again see that on the closing stock there is a loading of 60. Opening stock 20, purchase 100, sales 120. Here, if you can see, whatever is this opening stock GST loading portion is there, that we have already claimed as a deduction in the previous year itself. So this 20 will not again come as deduction in the current year. This 120 minus 100 in the second year, again, we would have paid in cash. So that also we need not worry. What is worrying in the second year also? Closing stock GST portion only. Again in the second year, if you want the 60 to be removed from your addition, if you want to pay the same net profit, the GST loaded on the closing stock should again be paid before the due date of the filing of the return. So effectively, by the reason of 145A, your assessee's closing stock in its entirety, which is appearing as on 31st of March, should be sold before 31st of October itself. If it is not sold before 31st of October, then to certain extent, there will be a disallowance that is coming up. So to that extent, you will have to make a disallowance in the, both in Form 3CD and also in your computation. As I said earlier, there is now a distinction in the Income Tax Act. Your tax audit report is 1 month earlier, but your 43B disallowance can be, you can pay the amount anytime before the due date of the filing of the return. So to that extent, there will be a gap. How does the department address this gap? How does the income tax department verify this is a different scenario. But be that as it may, your closing stock, whatever is your closing stock, you will have to sell it and pay the tax before the due date of the filing of the return. So to that extent, especially this year being the Corona year, where most of the traders could not sell their stocks, please be very, very careful to the extent you compute your 145A disallowance. We'll quickly move on to clause 17. Clause 17 talks about transfer of land or building or both. Where a land or building or both is transferred, then such a transfer should be always at the value adopted by the state government for the purpose of levying of stamp duty. If you are selling your building at a value less than the amount indicated for stamp duty, then to that extent there will be an addition. If you're selling your land as a capital asset, then the addition will be under 50C. If you are selling a land as a stock in trade, then to that extent there will be an addition under 43CA. So whenever you are selling a land or a building or both, then to that extent ensure that you are not selling below the value fixed for stamp duty. If you are selling below the value, then in spite of not receiving the cash, you will have to admit the income under either 43CA or 50C. So whenever your assessee says he has sold a land, verify it with the stamp duty value. If at all the assessee has sold below the stamp duty value, it requires reporting under clause 17 of the Income Tax Act. Now there is a proviso which says up to 10% you can go ahead and give the difference. I mean, if there is a if the value is below the, the sale consideration is below the stamp duty value, but if the difference is not 10%, then to that extent you stand to benefit. You will not be allowed to, there will be no addition on your hand. But if the difference is more than 10%, then there is every possibility that you will have an addition coming up in your hand. So to that extent, the auditor has to exercise caution and report under clause 17 of the Income Tax Act. Now, there are case laws which have said that if an assessee introduces his personal asset into a partnership firm, where an assessee introduces an asset into a partnership firm, then what is the scenario? Does it mean that, for example, a partner is having a land as his capital asset, he is putting it in the partnership firm? As we all know, partner introducing an asset into the partnership firm does not require any deed. A normal partnership firm does not require any deed through which he is to introduce. He can normally say that he has introduced the land as a capital in the partnership firm. Now, in that scenario, should the partner, where there is a transfer of the land, what is the transfer value for the partner? The value recorded in the books of the firm is treated as the sale consideration for the partner. Where is it said? It is said in section 45 clause, subsection 3. Now, you also have 50C, which states that where a land or building is transferred, the sale consideration should be the minimum. It should be this stamp duty value. Now you have two different sections. One section says value recorded in the books of the firm is treated as sale consideration. Another section says if it is less than the stamp duty value, I will replace the sale consideration by the stamp duty value. There is a conflict between these two sections. What should be the scenario? Courts have time and again repeatedly held, at least we have a jurisdictional tribunal decision which has said that in the case where a partner introduces a capital asset into a partnership firm, to that extent, he need not record the asset at the stamp duty value. Whatever is the value recorded in the books of the firm, that will be treated as the sale consideration. A partner need not worry about what is the stamp duty value as far as introducing a capital asset is concerned. That is the law as of now. The law is yet to reach its finality in the Supreme Court, but be that as it may, we now have good decisions which have stated that 45 subsection 3 overrides 50C, and to that extent, you need not replace the stamp duty value of the land introduced in the partnership firm. That is as far as clause 17 is concerned. Clause 20B, this is a clause which has been just created a lot of havoc in the recent times due to the reason that there are innumerable decisions on both sides of the issue. Details of contributions received from employee for various funds. Where an employer collects from the employee certain contributions, then he'll have to remit them within the time allowed for those contributions. For example, take the case of Provident Fund, PF. If their employee contribution of the PF is collected, it has to be remitted within the due date specified under the Income Tax Act. Specified under the respective PF Act. Normally, PF of a month has to be remitted on or before 15th of the next month. A grace period of 5 days is allowed. So if he is remitting on or before 20th, then there will be no disallowance. But if he is remitting beyond the due date prescribed under that PF Act, then there will be a disallowance under 36(5)(a). As far as employer contribution is concerned, it is falling under the provisions of section 43B of the Income Tax Act. So if it is remitted before the due date of the filing of the return, then it is treated as sufficient compliance. Now, employee contribution is governed by 36(1)(5)(a). Employer contribution is covered by section 43B. 36(1)(5)(a) says you have to remit employee contribution before the due date mentioned in the respective act, PF Act or ESI Act, whatever is that act, due date is there, that is the applicable due date. 43B says the due date is the due date of filing of the return of income. So for employee contribution, you have a different due date, and for employer contribution, you have a different due date. Several people have said that for employee contribution, not 36(5)(a), but only 43B applies. Several courts have also agreed to the view that employee contribution is also covered by 43B. So to that extent, if the employee contribution is getting remitted before the due date of the filing of the return, then also it will be treated as allowed. So there are few judgments which said for employee contribution 36(5)(a) alone is applicable. There are a few decisions which said for employee contribution not 36(5)(a) but 43B is also applicable. As far as employer contribution is concerned, there is no dilemma, only 43B is applicable. So to that extent, there is no controversy. Now, if you want to rely on the favorable decisions which have said that for employee contribution only 43B is applicable, if there is a delay in the payment, please be very, very careful. Do not report under this clause. See, some auditors want to be very, very safe. They will report under this clause, but they will say, assessee, you need not admit this as an addition in your computation. We will rely on the judgments. It is a very draconian stand. You want to take a stand, take it right from the tax audit level. You want to say that for employee contribution 43B is applicable, not 36(1)(a), then you do not disclose anything under this clause of Form 3CD. But if you disclose under this clause of Form 3CD, then by 143(1), automatically whatever is the disallowance, it will be added to the returned income in the intimation. So because you want to be safe, you reported, the assessee will get penalized. And again, on that intimation, you will have to go on an appeal only to CIT appeals. So if you do not want to disclose it, I mean, if you want to rely on the judgments which said that for employee contribution also 43B is applicable, then do not report under this clause of Form 3CD. But if you report under this clause of Form 3CD, mandatorily it will be added in the 143(1) of the intimation if the assessee does not disallow, and there is no other recourse to the assessee except to go on appeal. It will not be treated under 154. So to that extent, please be very, very careful. Exercise your judgment and make a decision whether to report or not to report. The moment you do not report, you will be helping the assessee. But if you choose to report, then assessee will have no option but to get the amount cancelled only at the CIT appeals level. So please be very, very careful. This is not applicable just to this class. All the classes of Form 3CD. In fact, Form 3CD notes itself says, if you do not want to report any particular item because of a judgment, then no problem, do not report. But ensure that you have the judgment with you. So to that extent, please be very, very careful as far as class 20B is concerned. Now, what are all the judgments which are favorable? Only few decisions I have reported here. There are innumerable decisions which are favorable to the assessee. Similarly, on the other side also, there are number of decisions. So all that I have not brought here, but be that as it may, these are all the decisions. Those marked in green are those which are favorable to the assessee, and those marked in red are those which are against the assessee. So to that extent, please be very, very careful. Now, TDS related disallowances. The CBDT has repeatedly changed tax audit report under 3CD, but what they forgot, what they omitted is the amended law which has not been reflected in 3CD. What is that law which got amended but it is not reflected in Form 3CD? I will get back to you in 2 minutes time. I have already highlighted it in red in letters, but still I will get back to you in 2 minutes time. What is clause 21B talking about? It says wherever TDS is applicable, whether the assessee has properly deducted TDS or not, you will have to report. In case the assessee has not deducted TDS, then he will have to go in for a disallowance under 40A IA. 40A IA has got two provisos. What are those two provisos saying? The first proviso says the assessee has not subjected the expenditure to TDS during the previous year. No problem. But before the due date of the filing of the return, if the assessee deducts that amount and remits it before the due date of the filing of the return, then no problem. It will be treated as allowable expenditure only. That is the first proviso to 40A IA. What is the second proviso saying? If the payee, the payer is your assessee. If the payee is not, if your payer is not treated as assessee in default because the payee, the person who received the income, admitted that income in his return, showed it in his return, filed the return, in that scenario, from the payer, again TDS will not be collected. So to that extent, it will not be treated as a disallowance. So you have not deducted before the due date, before the close of the financial year, you have not deducted, no problem. You have not remitted it before the due date of filing of the return, still no problem. If the person who received your income, if the person who received the amount admitted it as income, and if he has paid the tax, then to that extent, and he should also file the return of income. If that person has paid the tax and filed the return of income, then to that extent, that expenditure, even though has not been subjected to TDS, it will be treated as an allowable expenditure. Now, if you read first proviso and second proviso together, if you read first proviso and second proviso together, if the person to whom you have made the payment on which TDS is not deducted, if he files his return of income much before you, before the due date itself, if he files the return of income much before you, and he furnishes to you a certificate in form 26A, then if he furnishes a certificate to you in form 26A, then there is no disallowance for you. Then there is no disallowance for your assessee. So reading first proviso and second proviso together, if everything happens before the due date of the filing of the return, then there is no disallowance. But in case the other person who has received the amount on which TDS is not deducted files his return belatedly, then the expenditure will be treated as disallowed, and it will be allowed only in the year in which the other party files the return of income. So to that extent, you will have to be very, very careful. Now, for a resident assessee, if the TDS is not deducted, the amount of disallowance is only 30% of the total expenditure. So for if on an expenditure of 1 lakh, the party has not deducted TDS, then only 30% of 1 lakh, that is 30,000 only, is disallowable. But for a non-resident, if you are making a payment to a non-resident, expenditure is paid to a non-resident, and on that expenditure, if TDS is not deducted, 100% of the expenditure is disallowed. So you will have to decide whether the payment is to a resident or to a non-resident. If the payment is to a resident, only 30% is disallowed. But if the payment is to a non-resident, 100% will be disallowed. So to that extent, you will have to be very, very careful while verifying the TDS provisions. Now, what is Form 3CD asking about? It says, what is the date of payment of the expenditure? What is the amount of the payment expenditure? What is the nature of the payment of the expenditure? Who is the payee? I mean, who is the other party? This has to be given for what? It has to be given for the items which have not been subjected to TDS. So where there are items of expenditure which are not subjected to TDS, you will have to give the details relating to date of payment, amount of payment, nature of payment, and the name and address of the payee. Now, there is a second limb to this clause 21B. It says details of payments on which TDS has been deducted but not paid before the due date of filing of the return under 139. The first proviso does not make a distinction between a resident and a non-resident. Payment can be to a resident, payment can be to a non-resident. Irrespective of the payee, if the TDS is deducted before the due date of the filing of the return, then it will be treated as an allowable expenditure. So whether you have made a payment to a resident or to a non-resident, if you have forgotten to deduct TDS, deducted before the due date of the filing of the return, it will be treated as allowable expenditure. Unfortunately, Form 21B, Clause 21B of Form 3CD does not reflect the same meaning as mentioned in the Income Tax Act. It says, if you are making a payment to a resident, TDS has to be deducted before the time expiry of the time prescribed under 200 subsection 1. The 200 subsection 1 talks about the due dates, which is 7th of the subsequent month. Now, the Act got amended. Act says, even to a non-resident, if you are making a payment and if you have forgotten to deduct TDS, if you deduct it before the due date of filing of the return and pay it, then it will be treated as allowable expenditure. So to this extent, the form remains unamended. The CBDT has forgotten to amend this part of the form. No problem. To the extent of this unamended form, you still have to give the details only relating to tax remaining unpaid before the due date of the filing of the return only. You should not give the data relating to expiry of time prescribed under 201. You should still give the data relating to TDS not deducted till the due date of the filing of the return, that is 139(1) only. Even though the form is amended, you will have to take the revised section only and give the details here. So irrespective of the wordings in the form, you will have to give the scenario as applicable under the section only. Why? Because 3CD form itself says where any part of the form is unamended, where any part of the form is unamended, you have to pick and give the data as mentioned in the section. Form requirement is not. So if there is a conflict between the form and the act, the form will not prevail, the act will prevail. Give the data as per the act only, not as per the form. This is the issue arising in clause 21B. Now, what are the important references? As I said earlier, refer to Rule 31 ACB. It says if you have failed to deduct, TDS, then obtain Form 26A. What should Form 26A? Who should be given? Who should give Form 26A? The chartered accountant should give. The accountant, as defined in section 288, should give Form 26A. Who's chartered accountant? Payer's chartered accountant or payee's chartered accountant? Any chartered accountant can give. It is not necessary that payee's CA only should give. A payer's CA can also give Form 26A. What should be taken care of before giving 26A? One, the amount paid by the payer must be shown as income by the payee. It should be shown in the return of income. It should be offered to tax and tax should be paid on it. Return of income should also be filed before the due date of filing of the return. If all these three conditions are satisfied, then it should be given in Form 26A, and then after obtaining 26A, payer can treat that expenditure as an allowable expenditure even though TDS has not been paid. What is the interplay between first provision and second provision of 40A? I have already explained. Your slide contains 3 case laws on short payment. All these 3 case laws state that whenever there is a short payment of TDS, then there will be no disallowance. I would not agree to the view given, but since these 3 case laws are favorable case laws, you can rely on them for judgment. For example, TDS has to be deducted under 194J. By mistake, you deducted it under 194C. In that scenario, there will be no disallowance. Had these 3 case laws not been there, I would have said you should have disallowed proportionate amount. For example, if you have deducted 2% instead of 10%, that 8% you calculate proportionately and subject it to disallowance would have been my view. But since in the case of short deductions, this 3 case laws would apply and there will be no disallowance, under 40A. Normally, if 194J is applicable, only TDS should be deducted as per 194J only. But by mistake, if you have applied 194C, then to that extent, relying on these 3 case laws, you can say that there will be no disallowance of expenditure. So that is how these 3 case laws will help you under clause 21B. Now, let us go to other clauses. Clause 21D talks about 40 capital A3. 40 capital A3 states that any expenditure paid to one person in one day should not exceed more than 10,000 rupees. So to the extent it does not exceed 10,000 rupees, there is no disallowance. But to the extent it exceeds 10,000 rupees, there will be a disallowance of that expenditure. That same analogy has been extended to capital expenditure also. The definition of actual cost in section 43 is now amended. By reason of that amendment, if you purchase any capital asset in cash exceeding 10,000 rupees, then the extent exceeding 10,000 has to be ignored for the purpose of actual cost. If it is ignored in the actual cost, that means depreciation is also not allowable on that portion. So even capital assets cannot be purchased in cash. Everything has to be made through electronic payment only. Check, account payee check, draft, or electronic payment. That is clause 21D. In case there are any items of expenditure paid more than 10,000 per person per day, then to that extent it requires reporting in clause 21D. Clause 21H talks about 14-year disallowance. If you have any exempt incomes, if you have any assets which yield exempt incomes, then to that extent you will have to make a disallowance in as per section 14A. 14A has to be read with Rule 8D. Rule 8D now gives you A into B by C formula. A is the total expenditure, B is the exempt assets, C is your total assets. So A into B by C formula you will have to apply and then arrive at your 14-year disallowance. Now, there are some assets which will yield both taxable income as well as exempt income. What are those assets? At least for the assessment year 2021, shares will yield both taxable income as well as exempt income. Taxable income, long-term capital gains is now taxable. Short-term capital gains is now taxable. Exempt income, dividend is still exempt for the assessment year 2021. So investment in share will give both taxable income as well as exempt income. How do you calculate 14A disallowance? There is no straight answer for this. Still, we need to work out what is the disallowance as per 14A. Now, take the case of an investment in a partnership firm. I have invested in a partnership firm. Will it yield only exempt income? The answer is no. Why? Interest on capital remuneration is still taxable from a partnership firm. Now, share of profit is exempt. So, an investment need not necessarily give only exempt income. It can give both exempt income as well as taxable income. There are adequate number of Supreme Court judgments on 14A. You have Godrej and Boyce decisions, Godrej and Boyce decision of the Supreme Court. You also have Maxop decision of the Supreme Court. All those decisions have said that 14A disallowance cannot exceed the exempt income. So if you have a dividend income of 1,000 rupees, your expenditure disallowance under 14A cannot exceed this dividend exempt income. So to that extent, you can restrict. You can also state that if there is no dividend income during the year, there cannot be a disallowance under 14A. So to that extent also, you are safeguarded. So that is as far as 14A disallowance is concerned. Interest under section 36(1)(3). Interest expenditure is allowable under section 36(1)(3). So any interest expenditure paid is allowable under 36(1)(3). But in case it is incurred for a capital asset, ICDS will come into picture. ICDS 7 dealing on borrowing cost will come into picture. So to that extent, the interest expenditure on a capital asset, interest paid on a loan taken to purchase a capital asset will have to be disallowed. It is not allowed as an expenditure. To that extent, there should be a capitalization of that interest expenditure. From the date the loan is taken till the date the expenditure is in, till the date the asset is capitalized, to that extent interest has to be capitalized. After the date of capitalization of the asset, the interest on such loan will be treated as your revenue expenditure. But till the date of capitalization of that asset, interest will have to be taken as cost of the asset itself. Now you have specified borrowing and general borrowing. Specified borrowing is very, very simple. From the date you make the payment till the date your asset gets capitalized, you will have to capitalize the interest as far as specified borrowing is concerned. But under a general borrowing, for example, you have OCC. From that also you are incurring a payment towards a purchase of a capital asset. In the case of general borrowing, from the date of borrowing till the date of the expenditure, till the date of the capital asset capitalization, you will have to make the disallowance of interest. You have to add it to the cost of the asset and then make the prepare the actual cost. So to that extent, there is a distinction between specified borrowing and general borrowing. ICDS will apply. So to that extent, you will have to apply the borrowing cost ICDS and then treat the expenditure under 36(1)(3). So if at all you feel any expenditure debited to P&L account requires capitalization, and if it is not so capitalized, you will have to report under class 21I. Interest paid to MSME, please be very, very careful. If at all any interest is paid to MSME, it will be disallowed in totality, irrespective of whether TDS is deducted or not. So interest paid to MSME is always disallowed. So please be very, very careful. If your assessee has really paid interest to MSME, you'll have to disallow it under class 22. Class 23 talks about specified related parties. If at all there are any payments made to related parties, you will have to report under 40 capital A 2B. 40 class 23 is only talking about payments to related parties. It is not asking about disallowances. It is only trying to capture factual information. So if at all there are any payments to related parties, you will have to report them under class 23. You need not report whether they are excessive or unreasonable. You simply have to report a factual data. There is no disallowance under this class. So these are all the other clauses, minor clauses, which are appearing in Form 3CD. Now we'll go to the next major clause, which is 43B. What is 43B stating? 43B states that whenever you are making any payment such as cess, duty, tax, leave encashment, gratuity, bonus, to any employee or payments to railways, then irrespective of the method of accounting, that expenditure will be allowed only if it is paid before the due date of the filing of the return. In those expenditures, interest to banks and financial institutions is also included. So interest, if it is paid before the due date of the filing of the return, it will be treated as allowed. If it is not paid before the due date of the filing of the return, it will be treated as disallowed. Similarly, taxes such as your GST or your other taxes, duties, cess, leave encashment, gratuity, or bonus or commission, whatever be the expenditure, they have to be paid before the before claiming it as a deduction. Only as far as the assessment previous year's expenditure is concerned, it can be paid before the due date of the filing of the return. If it was disallowed in the earlier years, if you pay it during the previous year, it will be treated as allowed. If you pay it before the due date of the filing of the return of income, it will not be treated as allowed. So you will have to verify what is the expenditure that you want to allow. If that expenditure is relating to the current period, that the expenditure was incurred in the previous year, then up to the due date of the filing of the return, it will be treated, if you pay it, it will be treated as allowed. If it is not paid till the due date of the filing of the return, it will not be treated as allowed. That is only in relation to the expenditure incurred during the previous year. That is a previous year subsequent to the, relevant previous year. For example, we are in the assessment year 2021. For the previous year 1920 alone, the expenditure can be paid till the due date of the filing of the return. But if the expenditure was incurred during earlier previous years, if it was incurred during 18-19 previous year or 17-18 previous year, and if it was disallowed at that point in time, then it will be allowed only on payment. For that, relevant payment should be made during the current previous year only. For that, the due date of the filing of the return condition will not apply. So to that extent, you will have to be very, very careful. Unfortunately, under 43B, there are two contradictory judgments of the Supreme Court. One is in the case of Modipon and another is in the case of Maruti Suzuki. Modipon's case dealt with the erstwhile PLA. Maruti Suzuki case dealt with the erstwhile RG23A. Both these decisions are very much reasonable or relevant now, because PLA is nothing but your electronic cash ledger in your GST, and RG23A is nothing but your electronic credit ledger in your GST. Now, what did Modipon said? Modipon's case, Supreme Court said, whatever is appearing as closing balance as on 31st of March in your PLA, that is your electronic cash ledger, irrespective of its adjustment, whether you have adjusted it or not, the moment it is appearing in your electronic cash ledger, it can be claimed as a deduction under 43B. That means it need not be adjusted to your liability. The moment it is appearing in your electronic cash ledger as on 31st of March, it can be claimed as a deduction under 43B. But the same Honorable Supreme Court in Maruti Suzuki case said, whatever is appearing as balance in your electronic credit ledger as on 31st of March as a deduction, it will be allowed as a deduction only if it is adjusted against a tax liability. In my personal view, the decision of the Honorable Supreme Court in Maruti Suzuki case is absolutely correct, and I would not agree with the decision of the Honorable Supreme Court in Modipon case. But be that as it may, Modipon is a more favorable decision than a Maruti Suzuki decision. So Modipon case said electronic cash ledger, whatever is available, will be treated as allowed, even though you don't set off. But in the year of setting off, you should not be treated as a deduction again. But in a Maruti Suzuki case, this Honorable Supreme Court said, whatever is appearing as a credit ledger balance, it will not be treated as a deduction. Now, when do you use these two decisions? Go by the normal provisions of set on set off as per the GST law. Claim as per the GST law. In case, during the course of scrutiny, if the officer adds any amount as unpaid under 43B, then if at all you have any electronic cash ledger balance, claim it as a deduction in Modipon case by using the Modipon case. So to that extent, as on 31st of March, advise your client to keep some back cash balance in that year as in electronic cash ledger. you can set it off in the subsequent year, but keep some balance in your electronic cash ledger. Tomorrow, if there is any addition that is coming up, then to that extent, you will be covered by the decision of this modi pon case. So utilize this modi pon case, but in my view, use it only in the scrutiny proceedings. Do not use it in your assessment itself. Do not use it while filing the return of income itself, because you will be exhausting all your options. In case in scrutiny something gets disallowed, you will not have the benefit of this section. So to that extent, please be very careful. Please be very, very careful and use the decision accordingly. Now, clause 29. Clause 29 is a very peculiar section because it states if at all a company is receiving consideration which is above the fair market value, to the extent it is exceeding the fair market value, it will be taxed as the income of the company. This is applicable only in the case of a company. For other things, it is this section, clause 29, is not applicable. Now, what are the various things that can happen in the case of allotment of shares? Due to paucity of time, I'm not covering everything in detail. To be very, very brief as far as clause 29 is concerned, if a company allots shares, if a company is allotting shares, assume it allots below the fair market value. If a company is allotting the shares below the fair market value, then to the extent of difference between the fair market value and the allotment price, it gets taxed as the income of the shareholder. If a company is allotting shares below the fair market value, the difference between the allotment price and the fair market value will get taxed as the income of the shareholder. If it is allotting the shares at fair market value itself, then there is no addition in the hands of either the company or the shareholder. Both are safe. But if it is allotting shares above the fair market value, then to the extent of difference between the allotment price and the fair market value, it gets taxed in the hands of the company. So if the shares are allotted above the fair market value, that income will get taxed in the hands of the company. If it is allotted below the fair market value, it gets taxed in the hands of the shareholder. So shares of a company should always be allotted at its fair market value only. Normally, if it is a new company, you can allot the shares at 10 rupees or the face value, whatever you like, nobody will question. But if it is an existing company and you are allotting fresh shares, then necessarily you will have to calculate fair market value. How do you calculate fair market value? Rule 11 UA talks about calculation of fair market value. It states that you will have to take into account the stamp duty value as far as immovable properties is concerned. For movable properties, you can take the book value and then reduce the liabilities and then calculate the FMV. So FMV has to be calculated by using the method prescribed in Rule 11 UA, or it can be done by a discounted cash flow method also. But the person who will sign that FMV has been adhered to is only a registered valuer or a merchant banker. No other person is allowed to sign the fair market value. Chartered accountants are prohibited from adopting the fair market value, from certifying the fair market value. So get your FMV done and allot the shares only at the FMV. FMV calculation itself is more complicated because as on which balance sheet date should I take the figures is a complicated question by itself. Sometimes it says you can take the previous balance sheet date. Sometimes it takes the date of the allotment is the date you should take the balance sheet. And these are all the complications. I'm not going into the nitty-gritties for the want of time. You should understand that as per clause 29, if the shares are getting allotted above the FMV, then it will be taxed as the income of the company. So it requires reporting in form 3CD. So to that extent, please be very, very careful. Interestingly, if you are allotting shares, there are number of sections which will hit you. For example, section 68 will also try and hit you if you are allotting the shares in the case of a company. Please be very, very careful as far as a company allotment of shares is concerned, because there are number of sections which can hit you when, especially with respect to allotment of shares. And it also goes for allotment of share, collection of share application money also. So to that extent, please be very, very careful. Now, clause 29A and 29B of form 3CD talk about income from other sources. 29A talks about advances collected where such advances so collected on account of a capital asset have been forfeited Up to 2017 or up to 2017, if I remember correctly, it was treated as reduced from the cost of the asset. Now onwards, from that 17 onwards, it will be treated as your income. So if an advance is collected on a capital asset, and if such advance is forfeited, it will be treated as income under 5629, and that requires reporting under Form 3CD. Although the income is getting taxed under income from other sources, you will have to necessarily report it under clause 29A of Form 3CD. So as I mentioned earlier, you cannot restrict yourself to the incomes appearing only under the head profits and gains from business operation. You will have to mandatorily see whether there is income, anything appearing under the head income from other sources. If it is falling under section 5629, then it requires reporting under clause 29A. Similarly, if it is falling under 56.210, then it requires reporting under clause 29B. What is 56.210? Any person receiving money above 50,000 without consideration or for inadequate consideration, or receiving mobile property or immovable property exceeding 50,000, either for without consideration or for immovable consideration, in that scenario, there is every possibility that there can be an addition under 56.210. So earlier 56.27 was there, before that 56.25 was there, before that 56.23 was there. Now all those sections kept on evolving. Now 56.210 is there. Earlier 56.27 was applicable only to individual and HUF. 56.210 now is applicable to all assessees, irrespective of whether it is individual, HUF, firm, LOP, company, whichever be the company. 56.210 will apply. It will apply to an LLP also. Please be very, very careful where there is an application of 56.210. Now, I have an example on 56.210. I am not taking up this due to want of time. We'll move on to the next class, which is class 31A or 31B of 269SS. 269SS says that where a loan or a deposit or a specified sum. What is a specified sum? An amount collected on a by reason of a transfer of a capital asset. With an intention to transfer a capital asset, if you collect any money as an advance, even though the transfer does not happen, it will be treated as a specified sum. So where a loan or a deposit or a specified sum is collected, then such a specified sum, loan or deposited, cannot be collected exceeding 20,000 rupees in cash. So only to the extent of 20,000 rupees you can collect in cash. Beyond 20,000 rupees, it has to be only through an account to pay check or an account to pay draft or through the ECS route. So in case there is a failure of the assessee and 269SS is applicable, then class 31A and class 31B of Form 3CD, there has to be a reporting made. What is now required to be reported? Name and address of the lender, amount of loan taken, whether the loan was squared up, that is whether the loan was repaid completely in the year, what was the maximum amount outstanding, whether such loan was taken or accepted through a check or a draft or an ECS, whether the check or a draft is an account payee check or an account paying draft. These are all the transactions which are required to be reported under 31A or 31B of Form 3CD. The only amendment which has come up now is that instead of PAN, even Aadhaar of a lender can be given. In that scenario, the assessee will now be able to, the department will now be able to track the case of the lender and the payer also. Please be very, very careful. If you do not mention the PAN or the Aadhaar of the lender, automatically your case will get selected for scrutiny. I have faced all that scenario. That is why I am telling it to you. If you do not mention the PAN of the lender or if you do not mention the Aadhaar of the person, then automatically the case will be selected for scrutiny. So even if you're collecting money from a retired pensioner who does not have PAN, then at least report the Aadhaar number so that there will be a tracking and the department will not put up your case, your client's case for scrutiny. So to that extent, please be very, very careful. Report at least the Aadhaar number if they do not have PAN. Because PAN and Aadhaar have now been made interchangeable. So to that extent, you'll have to make the reporting. 269ST is also there. 269ST says more than 2 lakh rupees, you cannot receive any money from any person per day. So there are three conditions there, either it is per day or per transaction or an event or an occasion. All that has been mentioned. So to that extent, you cannot receive more than 2 lakhs from any one person. Although the section 269 SS talks about receipt, the disclosure in form 3CD talks about receipt as well as payment also. Clause 31 BA talks about receipt otherwise done by check or draft or ECS, that means through cash. Clause BB talks about receipt by check or a draft, but otherwise done by account pay check or an account pay draft. So if you receive by a check, but if it is a bearer check, then you should report under clause BB and not under clause BA. If you are receiving only in cash, you will have to report in clause BA. If you are receiving by a check, but not by an account pay check or an account pay draft, then you will have to report in clause BB. Similarly, if you are making a payment in cash, you will have to report under clause BC. But if you are making a payment by a check, which is not an account pay check or not an account pay draft, then you will have to make a reporting under clause BD. So these are all the distinctions that are there in 269 ST. You can ask the question, how do we know whether the person has made through a normal check or through an account pay check? It is highly impossible for the auditor to know whether the assessee has made the payment either through a check, normal check, bearer check, or through an account pay check. It is not possible for an auditor to know. Similarly, if the receipts are there in the bank account, we will think it is received only through an account pay check. Sometimes a bearer check also gets deposited into the bank account, or a normal crossing without account pay return can also get deposited into the bank account. Just because it gets deposited does not mean that it is received through account pay. An auditor cannot conclude on all this whether it has been received through a check but not an account pay check. This is a highly difficult reporting problem. So the institute has now given in the guidance note that this particular disclaimer has to be inserted by the chartered accountant in all his form 3CADs before giving his audit report. By reason of this disclaimer, you will be able to claim that I am not sure whether it is by an account pay check or an account pay draft. To that extent, I can say that it is only through check or draft. So to that extent, it will help the chartered accountants in coming out of the liabilities prescribed in the form 3CD. So this is the guidance that is given. We will move on to the next clause, which is clause 34B. We are coming to the fag end of the session. I will leave at least 10 minutes for a question and answer session. Clause 34B of form 3CD states that wherever TDS has to be deducted, you will have to now see whether the TDS returns have been furnished in time or not. So you will have to collect the TAN number. You will have to see what is the respective form, whether it is 24Q or 26Q or 27EQ, whatever is that form, whether it has been filed or not, what is the due date for furnishing, what is the actual date of furnishing, all that has to be given. Not just that, apart from giving the due dates of 24Q, 26Q, you will also have to see what are all the transactions which are reported in each quarter of 24Q or 26Q. You will have to see if there are any transactions which are missed in reporting in 24Q or 26Q. If they are missing, then you will have to report in clause 34B of form 3CD. It is impossible for a chartered accountant to report whether any transactions are omitted in form 3CD. At best, what can be done in this scenario? Take out your tally or whatever is the accounting format. See what is the total of the credits of the TDS payable ledger. If that total is matching with the TDS appearing in the 4 quarters, then simply say that all the transactions have been reported. But if that total is not matching with the total amounts paid in the 4 quarters, then probably you will have to go and give the details that are there. Very, very draconian form of reporting. It says if there are any transactions which are not fully reported in 24Q or 26Q or whatever is the TDS form, then give the details of all those that are given, that are missing in form 3CD. Better to give a disclosure claiming that only material items have been verified, and to the extent they have been verified, everything has been come out. The whole problem is that form 3CB states that whatever is reported in 3CD is true and correct. And to verify true and correct, this will take an enormous amount of time. It is not possible for a chartered accountant to verify everything. So Institute also says verify only the material amounts. If the material amounts are not missing, then you can say that everything is proper in form 3CD. 36A of clause 36A of 3CD, it says, are there any deemed dividends under 2 clause 22E? If at all there are any deemed dividends, then you have to report. very, very draconian again. If there is a limited company, if such limited company is having shareholders holding more than 10% of the shares, and to such shareholders or directors, if a loan is given, advance is given, then such advance will be treated as dividend under clause 22E. So to that extent, it requires reporting in clause 36A of 3CD. So if at all there are any advances given by a private limited company to its directors or shareholders, verify whether they are given for genuine business needs. That means in order to purchase an asset or in order to do any other business purchase, if it is given as an advance, then it does not require reporting under 222E. But if it is given as a loan to such director, then 100% it will be treated as a deemed dividend. If it is treated as a deemed dividend, it will be taxable in the hands of the shareholder only, but the company has to give the disclosures relating to that deemed dividend. If it is for the assessment year 2021, the company should pay the tax under 115 at the rate of 30%, which is again a draconian provision. So to that extent, please be very, very careful. If at all your assessee wants money as a shareholder, then the best way to come out of 22E is to convert all your accumulated profits into share capital by allotting a bonus shares, and then thereby once everything becomes capital, you can issue a loan so that rigors of 222E will not get triggered. That way you can escape the possibility of 222G. Clause 42, it talks about Form 61 or 61A or 61B. Essentially, these are forms which are collected where PAN is not there, or where there is an SFT transaction, or where the Form 60 is collected have been sent to the department or not. On a very lighter note, every time I go, I would say that when we go to purchase a vehicle, normally when we go to purchase a car or when we go to purchase a two-wheeler, they will give you a bunch of documents and they will ask you to sign. But if you carefully see, it will contain Form 60. Form 60 has to be given only when you do not have PAN. But normally the dealer will say, sir, please sign on Form 60 also. I would normally, whenever I have purchased a vehicle, I would say, I have given you form, so I don't want to sign Form 60. He will say, no, sir, it is a part of our process. We have to find Form 60. Form 60 should be signed only when you don't furnish your PAN to the person who is required to deduct TDS. Unfortunately, even in spite of furnishing PAN, normally people ignorantly collect Form 60, which is totally wrong. All the Form 60 is collected have to be given to the department. For that, Form 61 is applicable. Similarly, 61B talks about your SFT transactions, statement of financial transactions. It has to be given as per section 285A, read with rule 114E. If such SFT has to be filed, you have to indicate whether SFT has been so filed or not. SFT is required to be filed only in two circumstances for a normal assessee. If he is a company, if he is allotting shares, or if he is collecting share application money above 10 lakhs from one person, then he will have to report that transaction in your SFT. Similarly, if you are a shareholder, if you are a dealer or a salesperson, if you are selling goods above 2 lakhs in cash, then also you will have to report it in your SFT. If you are collecting more than 2 lakhs in cash, then automatically you will invite the rigors of penalty under 269 ST. So why would you report it under SFT? I still don't know the answer, but be that as it may, if you are a tax audit guy, you are to whom 44AB is applicable. If you are collecting more than 2 lakh rupees in cash for sale of goods, then you will have to report it in your SFT. Normally, SFT, the general question people ask is that if I do not have any transactions, should I file SFT? The answer is no. If you do not have any transactions, you need not file SFT. But if you have 1 or 2 transactions, you will have to file SFT. And if that filing has been missed, then the auditor has to point out in clause 42 of Form 3CD. This is the clause 42. The other provisions, shares, share applications, how do you deal with the transaction in shares? This is something that you can understand when you read this slide, so I'm not going into the depths of this section. I'm also trying to skip this slide. I will go to trust. I will spend some time on the trust because trusts are also very, very important. For trust, you don't do a 44AB. You only issue the audit report in Form 10B. Now, trusts are very, very different when compared to your normal assessees. Why? Because in a trust, You don't follow headwise computation. You follow computation as per normal commercial procedures. So as per normal method of accounting, you will report your income. You need not follow, for computation purpose, you need not follow headwise deduction or claiming that. You can simply calculate normally. What is your total gross receipts? Out of the gross receipts, 15% is normally allowed as normal accumulation. For 15%, you need not do anything. The balance 85% you should spend. If for by any reason you are not able to spend 85%, you have two options available. One for accumulation using Form 9A. The second is for accumulation using Form 10. 9A can only be used if the income that you wanted to spend but could not spend was not received. For example, take the case of FDRs. Interest on FDRs, if you could not receive that interest by reason of accrual, but if you are still admitting it as gross receipts, then you can say that I was not able to spend 85% because some portion of my income was not actually received to me. So to that extent, you can go and file Form 9A. 9A states that if you are making an accumulation by filing 9A, 9A is effectively there in explanation 1 to section 11. So if you are making an accumulation under explanation 1 of section 11, then you will have to spend it in the year in which it is received. So if you are receiving it in the next year, you will have to spend it in the next year. If you don't spend it in the next year, it will be treated as your income. Now, if that is not your case, you want to spend the amount but on a very particular purpose, and for that purpose you require larger amount. For example, you have received say 1 lakh this year. You don't want to spend, you want to spend it on a building fund, but to construct a building you require at least 10 lakhs. So you want to accumulate this amount. So in that scenario, as per subsection 2, you can accumulate for 5 years by filing Form 10. So you can make an accumulation either under explanation 1 by filing 9A or under subsection 2 by filing Form 10. If you file Form 10, you can accumulate it for 5 years. If you file Form 9A, you can take it to the year in which it is actually received. In the year in which it is actually received, you will have to spend that amount. Now, whether to accumulate or not, you have to decide. The moment you start to accumulate, you have to mandatorily file either 9A or 10 before the due date of the filing of the return. If you miss by chance the filing of 9A or 10 before the due date of the filing of the return, to the extent of accumulation, tax will be levied at MMR. So please be very, very careful. That is point number 1. Point number 2, whether a normal tax audit assessee files the return before the due date or not. If the trust which has got an exemption under section 11 does not file the return of income before the due date, then the trust will lose its exemption under section 11. So in that year, the entire income becomes taxable. So for a trust, if you are having trust cases, park all your non-trust cases aside. First complete all the trust. Take up the trust, finish off them, and then go ahead for non-trust cases. Why? Because if you do not file the return of income within the due date, then the trust will lose the exemption. Trust does not have a concept called as belated return. It will have, you can file a belated return, but you will lose the exemption under section 11. So trust should always file the return of income before the due date of the filing of the return. If you are filing your return belatedly, I am again warning you, you will lose your exemption under section 11. So what are all the documents that a trust should file before the due date of the filing of the return? First, the trust should file its audit report in 10B. It should not miss. If you don't file your audit report in 10B, again, your income will be taxed at MMR, even though you file your return of income before the due date of the return. So audit report should be filed in time, return of income should be filed in time, and if you are making an accumulation, 9A or 10 also should be filed in time. These 3 documents have to be filed before the due date of the filing of the return. If you are by chance missing any of these 3 documents, your income is taxed at MMR. Similarly, if you are having expenditure, verify whether you have complied with 40 capital A3 relating to cash payment 10,000 or more and the TDS provisions. If by chance the trust does not deduct TDS, then that portion of the amount will not be treated as application of income. It will be removed from your application. Similarly, if you have made any cash payments, it will be removed from your application of income. It will create unnecessary problem. So to that extent, please be very, very careful. Ensure that the trust is following the TDS provisions and the cash payment policy 10,000 or more properly. Similarly, all your expenditure should match with the objects of the trust. Objects of the trust are written either in the trust deed or in the society bylaws. Any expenditure incurred which is not relating to the objects of the trust will make you liable for disallowance of section 11, and thereby the trust will lose the exemption. So please be very, very careful. If the objects of a trust are for school, then you cannot spend on a medical expenditure. If the objects of a trust are for school, you cannot spend on medical expenditure. You cannot spend on relief to tsunami victims. You cannot spend on relief to earthquake victims. If the objects of a trust are school, you should run only school. If the objects of a trust are medical, you can run only medical. You cannot sponsor someone's education in a medical trust. So objects of the trust and the expenditure should go hand in hand. Even if you are spending for a charitable activity, still that charitable activity should also be mentioned in the object. If it is not there, whether you spend for charitable activity or for any other activity, the trust will lose its exemption. So please be very, very careful as far as your trust exemption is concerned. Similarly, in the case of unregistered trust, if you are getting corpus donations, you will be hit by the provisions of 56(2)(10). So to that extent also, please be very, very careful. So these are all the precautions one should take while filing the trust returns. Due to want of time, I may not have covered anything in detail or in depth, but I sincerely seek your apology. I am open to all questions now. For the next 15 minutes, I'll be willing to take all questions, whatever you pose on the issues relating to tax audits, either under trust or normal assessees. The slides will be made available to you. Only today, I have come to the knowledge of an amendment which has come in Form 3CD. This amendment has come only today, at least to my knowledge, to my email ID. I have received the amendment in Form 3CD only today. It is talking about the exercise of option under the beneficial regime. Normally, under 115BAA, the tax rate is 22%. Under 115BAB, the tax rate is 15%. But for that, there are certain conditions which have to be complied. It should not be a new entity. BAB requires you to form. It should be 115BAB requires a new entity to be formed. There should not be any reused plant and machinery used. There should be new plant and machinery. All those conditions are there. 115BAA and 115BAB were introduced by way of a taxation amendment ordinance in 2019. They were legitimized by becoming part of the Act in the Finance Act 2020. Under those sections, if you want to opt to those sections, you will have to give a form which is called as Form 61A. That form has to be filed before the authorities. Sorry, Form 10 IC. I don't remember the exact form number. I believe it is Form 10 IC and 10 ID. But be that as it may, that respective form has to be filed. And if you are exercising an option. And similarly, to the extent there are brought forward losses, it also requires adjustment under 115BAA or 115BAB. This is a new adjustment which has been brought in only today. Till now, it was not there. The amendment to Form 3CD has come only today. That is why ITR 6 has now been introduced for e-filing. There is an amendment to ITR 6 also. Now, all that has come only today. So these are all the things that I wanted to discuss with you on Form 3CD and the tax audit report. I thank you all for a very patient hearing. I am open to questions. Any questions from your side, I am willing to take for the next 15 minutes. Over to you, Vamsi sir.
Dear members, if you are having any questions, you can unmute your mic and you can raise your questions. Sir is ready here to answer all your questions.
Hello.
Yeah.
Sir, this is Sujit Jain.
Yeah, please tell me, sir.
Hello, sir. Sir, my question is regarding section 40A2B. I have this doubt for long.
Yeah.
Whether any payments made by an individual to his HUF status, to his son's HUF status are to be reported in 40A to B payment?
Not required, sir. Any transaction between the HUF and its members, any transaction between the HUF and its members are exempted. I mean, they are not forming part of related parties. So to that extent, if you are a member of your HUF, then you need not require reporting under 40A to B. But if it is your son's HUF, if you are not a member of your son's HUF, obviously your son will be the Karta and his HUF is a distinct HUF in which you are not a member. In that scenario, it requires reporting under 40A to B.
So payment to individuals HUF need not be reported.
Transactions between HUF and its members need not require reporting under 40A to B.
Okay, sir. But son's HUF needs to be reported.
Absolutely, absolutely.
So, okay, sir. Sir, one more doubt.
Yeah.
Because since if anyone wants to ask the question, I'll wait. Otherwise, I'll put the question.
No, please go ahead. I will be there. Other questions also I will take. No problem. You can raise your hand.
Sir, one more question is regarding this books prescribed under section 44AA for a normal business tax audit case. Whether this 44AA, what is to be filled there, sir? We are just filling no books of accounts are specifically prescribed under 44AA or not applicable, we are writing. What is the apt comment, sir?
Sir, the word books of accounts are defined in the Income Tax Act. The word books of accounts are defined under the Income Tax Act. Only for the professionals specified in 44AA subsection 1, there are prescribed books of accounts. For the 13 professionals prescribed in 44AA1, books of accounts are prescribed. For a normal trader, books of accounts are not prescribed. So you can simply say books of accounts are not prescribed. Having said that, what are the books of accounts maintained by the assessee? You can still say day book, ledger, cash book, all these are books of accounts prescribed for and they are not prescribed. They are maintained by the assessee. You can also state whether you have verified them or not. Yeah. See, even for I will try and explain it a little further. For a professional under 44AA1, there are such a set of books of accounts which are prescribed. Apart from those books of accounts, for a medical practitioner, daily case register and inventory relating to the stock of medicines should also be maintained. To that extent, you will agree with me. For a medical practitioner, Form 3C, which contains the daily case register and the inventory ledger should also be maintained. But should this be reported in the books of accounts under Form 3CD? The answer is no. The word books of accounts would mean only cash book, ledger, and day book. So even the daily case register and inventory books, inventory of stock of medicines is prescribed for a medical practitioner under 44AA1, you need not report it in Form 3CD. Whether he has maintained or not is a different issue. You need not report it in Form 3CD. But day book, ledger, which are prescribed under 44AA1, if it is in the case of a professional, you should say yes. If it is any other person, you can say no. If it is, what are the books of accounts maintained? You can say day book, ledger, cash book. And then what are examined, whatever you have verified, you can say you have verified. So for a normal trader, what are the books of accounts that you want to say are maintained? You should derive that from the definition of books of accounts. I will take you to the definition of books of accounts. Give me 1 minute time. Books of accounts is defined in Section 2, Clause 12A. Section 2, Clause 12A defines books of accounts. It includes ledger, day book, cash book, account books, and other books. So basically, for a trader, he should maintain books of accounts, which include ledger, day book, cash book, bank book, that's all. So that alone you can write. You can say that there are no prescribed books of accounts. I have maintained day book, cash book, ledger. I have verified them also. I mean, the assessee has maintained, I have verified. It is sufficient compliance of Form 3CD. Hope I have clarified your doubt, sir. Anything else?
Yes, sir. Yes, sir. Clarified, sir.
Sir, one of the member is asking a question that what is the due date for trust for this assessment year 2021?
Sir, the due date for filing the audit report of a trust is 31st of October as of today. There can be an extension, but as of today for a trust, the due date for filing of Form 10B is 31st of October. If you are not filing your audit report by that date, the trust will lose its exemption. So for a trust, the audit report should be filed by 31st of October. The due date of filing of the return of income is 30th of November. So audit report should be filed by 31st of October. Return of income can be filed before 30th of November. Accumulation form also can be filed before that date.
Good evening, sir. I'm Teja. Sir, I have a small doubt.
Yeah.
In case of partnership firm, in 3CD in accounting ratios tab, whether we need to show the net profit before appropriation or the taxable profit which is being taxed.
See, which one? The accounting ratios, sir?
Yes, sir. In the accounting ratios in 3CD.
Generally, it is the net profit before. See, for a normal partnership firm, we prepare two accounts. One is the profit and loss account, another is the profit and loss appropriation account. Appropriation account is for the purpose of distribution of the profit to the partners. So when we talk about net profit in Form 3CD, it is only the net profit as per the P&L account and not distribution as per the appropriation account. So you will have to take only the net profit as per P&L account. You should not consider after giving remuneration and interest. It is only before giving remuneration and interest that you should consider.
Okay, thank you very much.
Sir, one more question. Is regarding the section 36. So one of my client is paying ESI on behalf of the employees. He is not collecting anything towards ESI contribution. And some of the clients are not at all collecting for EPF also. They are only bearing both the shares. So there will be no credit to employee share of PF contribution in the books of accounts. In that case, whether we have to report them in the Form 3CD, 3CB, 3CD, and also whether any disallowance will come if the employer deposits that monthly after due date, that contribution.
Sir, the whole problem is that in spite of not deducting from the employee, in spite of not deducting from the employee, if the employer himself is paying the employee contribution also, it only goes to show that you have given it to the employee and you have deducted it. If the employee is bearing the employee contribution part also, if the employer himself is bearing the employee contribution part also, then it means by a contract between the employer and the employee, it is given and deducted. That is the meaning of it. So to the extent the employer pays the employee contribution out of his own money, it will still be regarded as paid on behalf of the employee. So to that extent, the due dates mentioned in 36(1)(5)(a) only will apply. So there could be a possibility of disallowance. If you want to take a stand that because of the case loss, employee contribution is also covered under 43B, then you need not report these in Form 3CD, thereby no disallowance. But if you report it in Form 3CD, then it means that it will automatically come for disallowance because if it is not paid before the due date of the respective statute. So to that extent, you have to exercise your judgment.
So here we have to specify in clause 5 of Form 3CB that we have relied on the case laws, and since we have not shown it here.
Correct, 100%.
Okay, sir.
Sir, I would request your attention, Sudhit sir, I would request your attention to the notes of Form 3CD. You go to the notes of Form 3CD. I will read out the notes that are given in Form 3CD. That will clarify your stand. It says 3CD notes given at the end of the form. Even if you go to the website, it will be there. If you go to the end of the form, it says where a particular item is not given because of following the judicial pronouncements. Judicial pronouncements may be relied upon in the matter of inclusion or exclusion of an item in the particulars to be furnished under any of the clauses of the statement. So if you are relying on any judicial pronouncement for an exclusion of an item, there is no problem. You need not disclose it in Form 3CD. This is given very much in the Form 3CD notes itself. So there is nothing that is prohibiting you from excluding it by relying on the judgments. So to that extent, you can decide whether to include it in Form 3CD or not. Sujit sir, okay?
Okay, sir. Understood. Just case law we have to write down on clause 5.
Absolutely, absolutely.
Okay.
I have already given some in my slides. Others, if you can search also, you will get. I have a query from BMB, sir. It says, is it mandatory to provide provision for tax in the books of accounts? Sir, provision for tax is something which is forming part of the word current tax. Current tax includes provision for tax and deferred tax. Provision for tax and deferred tax, current tax and deferred tax should be disclosed in the books of accounts as per AS 22. AS 22 is an accounting standard given by the institute. It is not an ICDS. It is not an ICDS. It is only an accounting standard given by the institute. For a company, it is mandatory. There is no doubt about it. For a non-corporate assessee, there is no legal framework in which an assessee should report. It is only an auditor who should say whether AS 22 is complied or not. So if your assessee is not complying with AS 22, then there is no legal framework in which an assessee can be pressurized to put provision for tax. Only thing is that you will have to state that the assessee has not complied with AS 22. That is the only qualification you can give. Where to give that qualification? I have already said that in the true and fair view given in the Form 3CB, you can state that the assessee has not followed AS 22. That is point number 3 of Form 3CB. You can state that the assessee has not followed AS 22, except that there is no compulsion on an assessee to follow AS 22 if he is a non-corporate assessee. So to that extent, there is no need to provide provision for tax in the P&L account. Sir, Subbarao sir, is your query clarified? Do you have anything to say on this?
Can we revise the tax audit report once uploaded?
Sir, the revision for an audit report, there are no rules prescribed either under the Income Tax Act or under any other statute for a revision of an audit report, especially tax audit report. The institute guidelines state that revision can be made provided the revised audit report revision is always possible, but you will have to ensure that they are within the guidelines of the institute. Institute says that a revision of an audit report cannot be made except where there is a fraud on behalf of the assessee or something else, some other information has come to the auditor after the issuance of the first audit report. There are certain set of conditions. There are auditing standards also on the revision of audit report. If those parameters are met, then you can issue a revised audit report. But otherwise, if you are done, you are not expected to do an error and then revise it in the form of a revised audit report. That is the whole point. But revision of audit report is permissible. That is the answer.
Sir, one more question is
yes
regarding section 269 SS and T.
Yes, sir.
So while reporting for unsecured 269 SS and 269 T, whether we have to report on aggregate basis all the transactions appearing on the credit side in 269 SS, aggregate amount we have to report, or each transaction for each loan?
With per person, sir. Per person, if you have taken more than 20,000 rupees in cash, you will have to report. It is on person basis, not on transaction basis. So if from one person you have taken more than 20,000 as loan in cash, then you will have to report.
Sir, in check also we are reporting here at Nellore.
Correct. Normally we report because the section says that whether he has collected, otherwise than by account payee or not. Normally the softwares people will require us to report. You have to report it only, but if it is You have collected in cash, then it will become a qualification. Otherwise, it is a normal disclosure requirement only.
Only disclosure requirement, but mandatorily 269 SS, all the credits aggregate we have to enter.
Loans taken should be reported. Loans taken, not credits, sir. Loans taken.
Yes.
Example, there is a purchase creditor. Purchase creditor does not require reporting under 269 SS. Similarly, payment to a purchase creditor does not require reporting. Only loans taken, that too not from banks or financial institutions. Only from individuals or firms, if you have taken loan, that require reporting.
That I agree, sir.
Book entry also requires reporting. For example, husband has made payment on behalf of wife. Then wife will record it as a loan. Husband will record it as a loan given debtor. That also requires reporting in the wife hands. 269 SS has to be reported.
Sir, it has to be reported, and whether squared off or something, yes, we have to write, or
if squared off means whether you have repaid in full during that year, whether that account is closed or not. If that account is repaid in full and account is closed, then you will have to say it is squared off. If it is not repaid, you say no to that account.
Okay, even book entries also we have to write.
Yes, sir.
Means if interest entry is passed to a loan, that amount also we have to report. Absolutely. In the aggregate.
No, it will come in the maximum amount outstanding during the year. There it will come, no, sir. So to that extent,
there it will come in the amount taken. We have to exclude this interest amount or include
you have
it.
to exclude this interest amount. Taken means only amount taken, not interest converted into loan.
Only taken through bank.
Yes, yes.
And book entry also. Now you are saying.
Also. Yes, sir. Yes.
Total both aggregate we have to report.
Yes, sir. Yes, sir.
Okay, sir. And what? Doubt, sir. Another person doubt. Then I'll ask.
Sir, I have a query, sir. Here, interest expenses paid to NBFC, whether TDS provisions are applicable or not. In my view, they are not applicable, sir. 194A excludes some financial institutions. So to that, NBFCs, in the sense, if you are making a payment to a private party like Shriram City Union Finance or Birla Bajaj Finance, all those cases TDS would be applicable. TDS would be applicable. But if it is in the nature of a banking institution, then TDS is not applicable. NCML Finance also 100% TDS is applicable. 194A will apply if your exceeds 5,000 rupees.
In book entries, purchase of capital assets by book entry exceeding 10,000 attracts disallowance.
Capital expenditure by book entry, in the sense, what is book entry, sir?
Book entry means journal entry.
Correct. But who is making the payment?
See, on behalf of me, somebody might have made the payment, sir.
If he has made the payment in cash and you are only recording book entry, then it will require disallowance. But if he has made in check and you are recording by book entry, then it will require, then there is no disallowance.
Okay.
There is one more query, sir, with regard to prawn culture and other perishable commodities. Payments normally will be more than 10,000. Suppose the farmer or agriculturist sells his produce to agents or purchasers, what precautions are to be taken? Sir, there are two concepts here. If you are a farmer, if you are making payments, per person per day 10,000 limit is applicable. So per person per day, you should not make payment more than 10,000. Normally, if you are purchasing from a farmer, your item is defined as an exception in Rule 6DD. Rule 6DD gives the list of exceptions to this 40 capital A3. So any payment above 10,000, if it is falling within the list of exceptions given in Rule 6DD, then to that extent, there is no disallowance. Check whether your payment is falling within the exceptions of Rule 6DD. If it is falling, then you can make more than 10,000 payments also. But if it is not falling, then for you, provisions of 40 capital A3 will apply. As far as receipt by a farmer is concerned, still 269 ST will apply. So even a farmer cannot accept more than 2 lakh rupees on sale of his produce. So even a farmer cannot take in cash more than 2 lakh rupees. So to that extent, 269 ST will apply for receipts and 40 capital A3 will apply for payments. This is the distinction.
Sir is asking specifically in related to prawn culture, sir.
prawn culture, give me 1 minute. I'm going to rule 6DD here. If your payment is falling within rule 6DD, you are exempt. Otherwise, your payment is covered by 40 capital A3. Give me just 1 minute. Rule 6DD includes produce of animal husbandry. So to my view, your question is covered within the exception of rule 6DD. So for you, payment of 10,000 rupees criteria is not applicable. You can make beyond 10,000 rupees also.
Sir, one of my member is asking a question. He is facing a problem while filing Form 26A in traces. While uploading non-deduction details in the prescribed format, it is prompting only NGIF format is allowed. Any practical guidance on it, sir?
Sir, I believe Form 26A was with regard to person who has received income on which TDS is not deducted. So if a person has received income on which TDS is not deducted, the person who has paid, the payer will suffer disallowance. In order to overcome that, Form 26A must be obtained from a chartered accountant and given to the payer so that he will not suffer 40A IA disallowance. 26A, in my personal view, was there in the e-filing portal, not on traces portal. It was there only on e-filing portal. Originally, it was there. Subsequently, I mean, in March 2020, they have removed 26A from e-filing portal. After that, I have not seen 26A in e-filing portal. If they have introduced this in Traces website, I am sorry, I am not aware of it. 26A originally was there only in the e-filing portal. They have removed it in March 2020 from e-filing portal. So in my view, 26A has to be given manually. If they have reintroduced it in Traces website, I have not seen that and I am unaware of it.
Okay, sir. Sujit, you are asking some question.
Sir, my question was regarding this TDS section, clause 34, sir. Tax deduction at source, whatever. All the applicable payments, we have to note it down, sir. Means even though we have not deducted TDS because it is not liable, then also we have to report all those payments.
If it is not liable, you need not report, sir. If it is liable only, you'll have to report.
The salary.
If you are asking about a schedule, final annexure 1 to this Form 3CD, there will be a big table. What are all the expenditures incurred? What is the total payment? How much is it is exempt? How much is it is taxable? That table you are asking, huh?
Yes, sir. That table I am asking.
You will have to report the entire expenditure, sir. Whether it is liable or not, you will have to report.
Entire whatever applicable salary,
Absolutely.
Contract, interest, everything,
yes,
total amount
yes.
we have to write.
Yes,
if
sir.
it is taxable amount, we have to write separately and the tax deducted on that.
Yes, sir.
Okay.
Yes, sir.
Even it is 0, we have to write 0 because it is not applicable.
Yes, sir. Yes, sir.
Okay, sir.
Sir, there is a follow-up question, sir. In my earlier question, sir, in case we have taken 26A from NCML Finance, then okay, for non-deduction of TDS. You are right, sir. You can take Form 26A or you can ask NCML to give the non-deduction of TDS certificate they have obtained. Normally, all finance companies will go to the assessing officer and obtain a no TDS deduction certificate from the officer himself, TDS officer himself. You can ask him to produce that non-deduction of TDS certificate to you. If he is furnishing, do not deduct TDS. If he is not furnishing that, ask him to give a 26A certificate from his auditor. Relying on that, you can go ahead and claim the expenditure without TDS.
Hello, sir.
Yes.
Sir, 216 SST private financial institutions mention cheyakarle sir adi
269 SS
yes sir దాంట్లో 3CD ఫామ్ లో మామూలుగా మీరు అన్నారు కదా బ్యాంక్స్
3CD లో 260 బ్యాంక్స్ ఫైనాన్షియల్ ఇన్స్టిట్యూషన్స్ తప్ప ప్రైవేట్ ఫైనాన్స్ లో అయితే మీరు మెన్షన్ చేయాల్సిందే సార్.
అంటే ఇప్పుడు సుందరం ఫైనాన్స్ అయ్యి బజాజ్ ఫైనాన్స్ అయితే మెన్షన్ చేయాలి
సార్.
సార్ నెక్స్ట్ అది 26A సార్ అది ఒక మనము ఇప్పుడు జనరల్ గా బిజినెస్ పీపుల్ వాళ్ళ ఫ్యామిలీ మెంబర్స్ అందరికి TDS చేస్తుంటాం కదా ఈ దీని కింద 26A అసలు ఈ TDS చేయడం మళ్ళీ వాళ్ళు క్లెయిమ్ చేయడం అన్ని ఆపేయచ్చు కదా సార్ అటువంటిప్పుడు
26A ఇచ్చా సార్
అంటే ఓన్లీ స్క్రూటినీ టైంలో అది ఒక రిస్క్ కింద వస్తుంది అనేవాళ్ళు కదా
సార్. మీరు ఒక ట్యాక్స్ ఆడిట్ అసెసీ అయ్యుండి TDS పట్టుకోకపోతే వచ్చే డేంజర్ ఏంటంటే డిజలవెన్స్ ఎలాగో 26A ఇస్తారు, డిజలవెన్స్ ఆఫ్ ఎక్స్పెండిచర్ ఉండదు. కానీ మీరు డిడక్ట్ చేయాల్సిన డేట్ నుంచి మీరు 26A ఇచ్చే డేట్ వరకు ఇంట్రెస్ట్ ఆన్ ద టీడీఎస్ రన్ అవుతుంది. ఇంట్రెస్ట్ ఆన్ ద టీడీఎస్ ఇస్ 1.5% ఆన్ దట్ అమౌంట్, 1.5% పర్ మంత్. అది అన్నెసెసరీగా కట్టాలి కదా. దానికంటే టీడీఎస్ పట్టుకొని రిటర్న్ వేసి ఎక్స్పెండిచర్ చూపించుకోవడం అలవ్ అవుతుంది. సిమిలర్లీ మీకు దీన్ని ఏమంటారు, ఇక్కడ రీఫండ్ క్లెయిమ్ చేయడం ఈజీ అవుతుంది కదా. ఫ్యూచర్ లో ఇంట్రెస్ట్ కట్టి ఆ ఇంట్రెస్ట్ మళ్ళీ అలౌబుల్ ఎక్స్పెండిచర్ కాక ఇబ్బంది పడే కంటే.
అంటే యాక్చువల్గా అదే సార్, ఇంతకుముందు స్క్రూటినీ కేసులో అది రిస్క్ కింద వచ్చింది ఆ ఫామ్ అది. బట్ ఇప్పుడు మీరు రిటర్న్ ఈ ముందైనా సబ్మిట్ చేసుకోవచ్చు అన్నప్పుడు
చేసుకోవచ్చు, కానీ ఈ ఇంట్రెస్ట్ ఆగదు కదా. ఇంట్రెస్ట్ ఆగదు, మీరు టీడీఎస్ ప్రొవిజన్స్ ఫాలో అవ్వట్లేదని రేపు వాళ్ళు
అది నోటీస్ వస్తే. ఓకే
సార్, ప్రాసిక్యూషన్ కూడా లాంచ్ అవుతుంది సార్ టీడీఎస్ లేకపోతే.
ఆ 26A ఇచ్చినా కూడా అది వైలేషన్ ఆఫ్ టీడీఎస్ ప్రొవిజన్స్ కిందకి వస్తుంది.
అబ్సల్యూట్లీ 26A ఇచ్చినా కూడా ఇంట్రెస్ట్ ఆగదు, ఇంట్రెస్ట్ కంటిన్యూస్ గా రన్ అవుతుంది. కాబట్టి ఇంట్రెస్ట్ తప్పించుకోవాలంటే టీడీఎస్ పట్టాల్సిందే మీకు.
ఓకే సార్, ఓకే, థ్యాంక్ యూ సార్.
Sir, a trust receiving donation in cash up to 2 lakhs, is there any violation?
Sir, trust donation 2 lakhs కాదు, 20 lakhs తీసుకున్నా there is no violation. But if the person who is giving the donation cannot claim it under 80G. 80G కింద the maximum amount you can pay in cash is only 2000 rupees. If you are paying more than 2000 rupees, you cannot get a single rupee as deduction under 80G. So if a person gives 20 lakhs in cash, no problem, trust can take, but he will not get 80G donation. Trust kuno problem entante, if he is receiving 20 lakhs in cash, it has to show that it is not an anonymous donation. అంటే ఎవరి దగ్గర నుంచి వచ్చింది, ఎందుకు వచ్చింది, వాళ్ళ పేరు, ఐడెంటిటీ, వాళ్ళ దగ్గర నుంచి ఒక కన్ఫర్మేషన్ లెటర్, ఇవన్నీ ప్రూవ్ చేయాలి. ఇవి ప్రూవ్ చేయలేని పక్షంలో ఆ 20 lakhs అనానమస్ డొనేషన్ అయ్యి ట్యాక్స్ అవుతుంది 30% చొప్పున 115BB కింద. కాబట్టి ఆ రిస్క్ కూడా ఉంది.
సార్, మోర్ దాన్ 2 lakhs తీసుకుంటే 269ST వైలేషన్ అవుదా?
269ST వైలేషన్ అవుతుంది, కాకపోతే 269ST వైలేషన్ అవుతుంది. ఒక్క నిమిషం ఇవ్వండి, 269STకి వెళ్దాం. ఒక్క నిమిషం, జస్ట్ 1 minute. లో వాళ్ళు మాట్లాడిన పదం నో పర్సన్ షాల్ రిసీవ్ అన్నారు. కాబట్టి ఇప్పుడు మీరు డొనేషన్ తీసుకుంటే అది 269ST కింద వస్తుంది, వైలేషన్ కూడా అవుతుంది సార్. సో అంతవరకు ప్రాబ్లం అవుతుంది. కాకపోతే రీజనబుల్ కాస్ట్ చూపించవచ్చు కాబట్టి, గుడ్ అండ్ సఫిషియెంట్ కాస్ట్ చూపించవచ్చు కాబట్టి ఆ పెనాల్టీ పడుతుంది అనే గ్యారంటీ లేదు ట్రస్ట్ లో అయినా.
ఓకే సార్. సార్, రిగార్డింగ్ ద 26A క్వశ్చన్ సార్,
చెప్పండి సార్.
యాక్చువల్లీ 26A ఇప్పుడు ట్రేసెస్ లో వచ్చింది సార్. ట్రేసెస్ లో ఇట్ ఈస్ దేర్, ప్రొసీజర్, ఫామ్, ఎవ్రీథింగ్ ఇస్ దేర్, గైడెన్స్ ఉంది. బట్ అది లాస్ట్ 3 months ఐఎమ్ ట్రయింగ్ NGIP ఫార్మాట్ అని అలౌ చేయట్లేదు. క్వరీస్ వేస్తే కూడా ప్రాపర్ గా ఆన్సర్ రావట్లేదు
సార్. ప్రాక్టికల్ గా నాకు తెలియదు, నేను ఒకసారి కనుక్కొని నేను మీకు మళ్ళీ అనుకోవచ్చు చెప్తాను సార్.
ఇన్ కేస్ అంటే ఇప్పుడు మనకి టైం అంటే ఈ ఇన్ బిట్వీన్ స్క్రూటినీకి వచ్చే లోపల మనం ఫైల్ చేసుకోవాలి.
మాన్యువల్ గా తీసుకోండి సార్, స్క్రూటినీకి వచ్చే లోపల కూడా 26A ఇవ్వచ్చు.
ఓకే,
ఇప్పుడే ఇవ్వాలని ఏం లేదు, బట్ మీరు మాన్యువల్ గా కూడా తీసుకోండి.
ఓకే సార్.
అప్లోడ్ చేసేయండి. మీకు అప్లోడింగ్ కి టాక్స్ ఆడిట్ రిపోర్ట్ల దగ్గర P&L అకౌంట్, బ్యాలెన్స్ షీట్ కాకుండా ఎనీ అదర్ డాక్యుమెంట్ అని ఉంటది.
ఓకే,
దాని కింద అప్లోడ్ చేసేయండి. మీరు తీసుకున్నట్టు వ్యాలిడిటీ ఉంటది. ఎలక్ట్రానిక్ గా ఇవ్వలేదు అనేది ఒక టెక్నికల్ ఎర్రర్ వల్ల డిజలవెన్స్ ఇవన్నీ వచ్చే పాసిబిలిటీలు ఉండవు.
ఓకే సార్.
అట్లీస్ట్ టు దట్ ఎక్స్టెంట్ సేఫ్ గా ఉంది
సార్. దాని యూడిఎన్ ఏం చేయాలి సార్? దాని యూడిఎన్
కంపల్సరీ యూడిఎన్ కంపల్సరీ.
ఓకే
సార్, there is one more question. If purchased capital asset in cash under 48(3), the entire amount is added back to the computation, or to that extent depreciation claim is added back? To that extent depreciation claim is added back, sir. Not the entire amount is added. Only depreciation is not allowed on that capital expenditure incurred in cash.
Members, if you are having any further questions, you can unmute the mic and you can raise your questions.
more doubt, sir.
Yes, sir.
So in accounting ratio, there is material consumed to finished goods ratio is there. In that we have to write the rupee value or the quantity values.
Rupee value, sir. Rupee value.
Material consumed to financial. Okay, sir. Because what we are doing is we are writing the quantities, material consumed by yield, what we are getting.
Okay.
So that's why, sir.
No, sir. Generally they ask only rupees, sir. Rupees.
Okay.
Sir, adi materials consumed to finished goods produced, కదా sir?
Avun sir.
Finished goods produced versus materials consumed.
Yes, sir. But in accounting ratios, I am asking, sir, not kinda quantitative figures lo akkada kuda rastam malli yield of finished products rastamu.
Okay.
Ikkada accounting ratios lo వచ్చేటప్పటికి కొందరు ఫైనాన్షియల్ వాల్యూస్ రాస్తున్నారు. మేము వరకు ముందర నుంచి క్వాంటిటీస్ రాస్తూ వస్తున్నాము.
Sir, materials consumed by finished goods produced anedi it should always be less than 1.
Okay.
Endukante general ga if in your product 60% only will be the material cost, balance will be the labor cost. So వాడు ఏం చెక్ చేయదలుచుకున్నాడంటే వాట్ ఈస్ యువర్ మెటీరియల్ మార్జిన్ అనేది చెక్ చేయదలుచుకున్నాడు. కాబట్టి మెటీరియల్స్ కన్స్యూమ్డ్ బై ఫినిష్డ్ గుడ్స్ ప్రొడ్యూస్డ్ షుడ్ ఆల్వేస్ బి లెస్ దాన్ 100% ఆర్ ఆల్వేస్ లెస్ దాన్ 1. కాబట్టి మీరు రాయాల్సింది అక్కడ క్వాంటిటీ ఫిగర్స్ కాదు, ఓన్లీ రూపీ ఫిగర్స్.
ఓకే ఓకే సార్.
yes sir, there is one more query in the chat box, sir. It is quarterly stock statements and debtor statements given to banks, shall we generate UDIN? In my view, yes sir, you have to generate UDIN.
But stock statements, there is no need to sign, no sir. Why?
Sir, bankers are generally insisting in the sanction letter itself that it should be certified stock statements. So basically, auditors are supposed to check whether that stock statement is tallying with the books of accounts or not. We are not verifying the authenticity of that stock statement. We are only certifying whether it is as per the books of accounts or not. So to that extent, we'll have to report. Sir, any other certification key institute has given a very detailed guidance, detailed auditing standard. Our standard lo emuntadante everything should be followed by a report antadu. For example, bankers normally insist on projections, provisionals, all this thing. Normally projections, provisionals we will prepare and we will sign on that projections and provisionals. Daniki institute guidelines prakaram em cheppindante it should be followed by, it should be preceded by an audit report. ఆ కింద సైన్ పెట్టేటప్పుడు యాజ్ పర్ అవర్ ఆడిట్ రిపోర్ట్ ఆఫ్ ఈవెన్ డేట్ అని రాసి దాని కింద సైన్ పెట్టాలి. ఆ ఆడిట్ రిపోర్ట్ లో ఇవన్నీ నా క్వాలిఫికేషన్స్, ఐఎమ్ నాట్ వెరిఫైయింగ్ ది ఆథెంటిసిటీ ఆఫ్ ది ఫ్యూచర్ ప్రొజెక్షన్స్ యొక్క ఫైనాన్షియల్స్ యొక్క ఆథెంటిసిటీ వెరిఫై చేయట్లేదు, ఐఎమ్ ఓన్లీ సర్టిఫైయింగ్ ఇట్ ఆన్ ద బేసిస్ ఆఫ్ దిస్ అజంప్షన్స్ అని చెప్పి ఆ రిపోర్ట్ లో ఉంటది. సో ఆ రిపోర్ట్ ని పెట్టే ప్రొజెక్షన్స్, ప్రొవిజనల్స్ ఇవ్వాలి. కానీ జనరల్ గా మనం ఏం చేస్తాం అంటే కనుక ప్రొవిజనల్స్ తీసుకుంటాం, దానిపైన సైన్ చేసి ఇచ్చేస్తాం. అది కరెక్ట్ ప్రొసీజర్ కాదు. బట్ స్టిల్ ప్రొవిజనల్స్, ప్రొజెక్షన్స్ కూడా యూడిన్ జనరేట్ చేయాల్సి ఉంటుంది.
Members, if you are not having any further questions, we can close the session for today. We will see for another 1 minute. If there are questions, we will continue, or else we will close the session for today.
Sir.
Yes sir.
Sir, the trust మీరు డ్యూ డేట్ లోపల కానీ రిటర్న్ ఫైల్ చేయకపోతే మొత్తము ఇన్కమ్ కింద తీసుకుంటాను కదా, ఓన్లీ ఇన్కమ్ పోర్షన్ అది యాడ్ బ్యాక్ చేస్తే మొత్తం గ్రాస్ రిసీట్స్ సార్?
ఇన్కమ్ పోర్షన్ సార్,
ఓన్లీ ఇన్కమ్ పోర్షన్. ఇఫ్ ఇట్ ఇస్ లాస్, నో ప్రాబ్లం.
అబ్సల్యూట్లీ.
ఓకే
సార్, చాలా మంది ఏమనుకుంటారంటే కనుక ఎంఎంఆర్ లో ట్యాక్స్ అవుతుంది, గ్రాస్ రిసీట్స్ అని అనుకుంటారు. ఏదైనా ఫస్ట్ 11 ఎగ్జామ్షన్ అయితే ఓన్లీ ఆ ఇన్కమ్ పోర్షన్ ఎంఎంఆర్ లో ట్యాక్స్ అవ్వాలి.
ఓకే, థ్యాంక్ యూ.
సార్, రామరావు గారు, కెన్ వి సైన్ ది ప్రొవిజనల్స్ అండ్ ప్రొజెక్షన్స్ అని అడిగారు క్వశ్చన్. సార్, ఇదే క్వశ్చన్ యాక్చువల్ గా డిసిప్లినరీ కమిటీలో వన్ ఆఫ్ ది మెంబర్ ఆస్ట్. ఇన్ఫాక్ట్ ఆయన అడగలేదు, ఎంత ఆథెంటిక్ గా చెప్పాడంటే, హౌ కెన్ ఎ చార్టర్డ్ అకౌంటెంట్ సైన్ ది ప్రొవిజనల్ అండ్ ప్రొజెక్షన్ ఫైనాన్షియల్ స్టేట్మెంట్స్, యు ఆర్ డూయింగ్ గ్రేట్ డిసర్వీస్ టు ది ప్రొఫెషన్, అసలు వి విల్ డిబార్ యూ, అది ఇది అని కూడా మాట్లాడారు. అంటే disciplinary board lo కూర్చున్న members కూడా తెలియదు that we can sign projections and provisionals అని. Institute has issued a separate auditing standard for signing the future financial statements. అది కూడా పట్టించుకోకుండా ఇన్స్టిట్యూట్ డిసిప్లినరీ కమిటీలోనే కొందరు గవర్నమెంట్ నామినీస్ ఆర్ ఆస్కింగ్ us like that. But to answer your question, yes, we can sign projections and provisionals provided we take proper report ichi proper precautions తీసుకుంటే we can sign provisionals and projections.
Sir, Purnachandra sir, I think once we are signing provisionals, UDIN is mandatory, sir. So I hope your question is already answered. Sir, for personal IT returns where tax audit rules were not applicable, few clients were asking or insisting to do attestation activity. So can we
true copy attested ane daniki UDIN generation avasram ledhu sir. You can simply sign it as a true copy attested. FAQs lo UDIN yokka FAQs lo undi sir. If you are attesting it as a true copy, you need not generate UDIN. You can simply sign it, sir. అంటే దాని మీద కంపల్సరీగా మీరు ట్రూ కాపీ అటెస్టెడ్ అని చేత్తో అన్నా రాయాలి, లేకపోతే సీల్ అన్నా పడాలి. సే ఇట్ ఈస్ అ ట్రూ కాపీ అటెస్టెడ్, ఆ సీల్ ఉంటే కనుక యూ కెన్ సైన్.
Okay. So I think there are no further questions, sir. Sir, our secretary, Mr. Arun Kumar, has just logged out due to some technical error from his end. So I would like to propose vote of thanks to all the participants, members, and the faculty who has delivered a wonderful session today to all of us. And I personally thank all the participants for participating in the current today's program. And tomorrow also we will be having a session on various sections of income tax. So I would like to request the members to be present at the tomorrow's session also and make it a wonderful session. And sir, one of the member is asking for your mobile number. Hello. Sir, your mic is mute.
I will text my mobile number and email ID.
Okay, sir. Okay. Thank you. Thank you, members, for participating for today's webinar. Thank you very much.